yesterday, worst day of the year for U.S. equity markets, down 2% on the S&P 500. Down aggressively.
You sent me that email when you were watching Real Madrid.
When I was going through the markets yesterday watching a game, that was top of my mind, Tom. Where's the Dow year today?
The Dow? Yeah, right.
NASDAQ, negative 0.1% right now. Just a bit softer this morning. 3-day losing streak on the S&P 500. Longest of the month of February so far. Equities a bit softer in the face of this in the bond market. What happened to the breakdown of the correlation between equities and bonds? Yesterday, just equities down, bonds down. Yields up aggressively, like up 10 basis points plus across the whole curve. The 2-year comes in a bit today by 4 basis points, 468, after delivering a close above 470 in yesterday's session. We're getting closer, Tom. I know you're on lookout for this. Close to 4 on a 10-year, 394 on a 10-year right now.
Let's get out front of Edward S. Hyman this morning, joining us here with a call for real disinflation. And John, I'm going to suggest we went from Stanley Fischer as ultra accommodative to some form of accommodation. Dominique Constant, maybe the first one to mention restrictive and super restrictive. We're there. And now's when the heavy lifting starts. And that's what we're all living.
And we're milking out some dollar strength as well. Take a look at this on euro dollar. So euro dollar right now, 106.33. High of the year, 110.33. Do you know when it came? The day before payrolls. The day after the last Fed meeting, and then the data dropped and everything changed. So when we go into Fed minutes a little bit later, what are these Fed minutes actually worth at 2 p.m. Eastern Time, given everything we've seen between the Fed meeting and where we are?
Well, you've promised about 5 times that you would read them, so now you're going to say you're not, okay?
Okay, I'll give it to Tom Keene's skim.
Well, the chairman was asked in the news conference if they discussed the pause, and he said, and he did, what's your impression of Chairman Powell in that news conference? Something like that.
It was good, it was poetry.
And then he said, look to the Fed minutes. Something like that, okay. So he said, look to the Fed minutes for the discussion of the Fed pause. Now I think a lot of people are going to go through the Fed minutes as part of a scenario analysis. What will they do if this data picks up aggressively? And is there any insight whatsoever in those minutes that come out later?
Although, to Tom's point, it's kind of ridiculous because the reaction function changes every week, it seems like. So there is this question of, okay, we can game out what they're going to do, but ultimately they're going to do what they want to do. That said, they can give more of an impression from the minutes, so perhaps they can...
You're suggesting they can massage things a bit?
I am not the only one. They can emphasize certain points. They aren't going to make things up wholesale, but they could potentially eliminate reference to those that are voting against rate hikes.
Have we done a data check yet? Have we done
that was it.
Check? That was it?
All 3 boards,
okay, well, 3.94% out to 3.96 in the 10-year yield. I'm sorry, 4.00 10-year yield's a big deal.
It's a big change, Tom. We're getting closer. We're there on shorter maturities.
It's the whole curve lifting. Does everybody understand this is not inversion dynamics, spread dynamics? It's this. On radio, this looks good.
The whole curve shifted hard by 10 basis points.
My first exercise I do.
That was lovely.
Is 35 pounds each.
Are they lateral raises for the shoulders?
I don't know what they are, but they get the shoulders going. The girls like that.
Good.
Okay, let's do this. This is important. Where are we right now? Where we are is my theme for this year was the great zombie roll-up, because profitability, if you're not profitable, you're going to get rolled up, and we'll see how that goes through the year. But the second idea, maybe I played it too little, is price down, yield up. Is anybody prepared for price to go through the October lows? To review, the Bloomberg Total Return Index, this is the biggest, broadest of our series on this, down 18% was the carnage. And then the bounce was up 8% in price. And then we went down 4%. And if we go down another 4%-ish, we break through to new price lows, new yield highs. A topic for Brian Weinstein, head of fixed income, Morgan Stanley Investment Management. Brian, what's the probability, the likelihood, the outcome if we breach through to low price, higher yields?
Tom, I mean, I think no one was talking about it a couple weeks ago, but it's certainly possible, right? December 20-something, we were about this yield level on 10-year notes, call it about 3.9%. From that rate, for the year, you're going to be between probably 330 and 450 or so. So that puts us, through those old yield levels. I think a lot of people chased bonds a little bit too late in retrospect. It doesn't make them a bad buy, but it means that there could be more pain to come.
Well, okay, the bonds are there, but then what is the to-do list here? Are you and I mean literally on a Wednesday, are you opportunistic to acquire bonds, and in what way? Or are you just waiting to find that spot?
I think you're waiting to find a spot. I mean, I guess that makes you opportunistic. But if you look, you guys were just speaking about it. The Fed doesn't even know. We don't know what to look for. I think a lot of the indicators that we've been waiting for are either lagging or a bit stale. So I think uncertainty might start to re-steepen the yield curve. We've had an amazing bout of flattening. We touched minus 92 the morning of retail sales a couple weeks ago. I think we're around 75 negative right now. So yeah, if you steepen the curve, higher forward rates, you start to buy, but there's no reason to catch the falling knife. You need to wait for a reason for us to stop selling off.
Brian, this whole curve's a mess. You can get a 6-month at 5%, a 2-year at 468, a 7-year at north of 4%, a 10-year at 394, a 30-year at 396. Try and make sense of all of that. Here's the question for you, Brian, and I think it's a really important one. Are we facing a once-in-a-generation opportunity to lock in high yields? Or are we facing a new generation of high yields? And there's a big difference there. Because if it is the former and not the latter, I'm going to take on a 10-year and lock it in for as long as I possibly can, maybe even go longer than that. If it's the latter, then I can take the 6-month at 5% and know there's no real reinvestment risk down the road because this is a new world. Which one is it?
I think it's closer to a generational chance to buy. In other words, I don't think we're going to an environment we're going to be, let's say this is the new low. We're going to be between 4% and 6% on 10-year notes. I don't think that's the case. I think that there are natural reasons that growth here is slower, that the Fed will beat inflation. It will take a while, which the curve is telling you, but they'll beat it. So let's just say 10-year notes are in a longer term range of, 2.5 to 4.5 or 5. So I do think you want to buy. Listen, the front end is giving you a chance to park money, not worry too much, take some income for now. It's going to take money away from other markets, and that will continue to slow down the economy. I don't think we're setting a brand new regime, but I don't think we're going back to the regime where 10-year notes can trade 50 basis points or 75 for a long time.
So, Brian, with that in mind, as you look across the curve right now, what's sort of the optimal spot for you? What are you advocating for to lock in those rates for longer?
I've been, as you guys know, in the big flattener camp. I think I said minus 80 to 100. And I think we pretty much got there at 92. So I think what you want to do now is start to put money to work out the yield curve in the yield curve as time goes on here. So 2's closer to 470, 475. Maybe you get to 5, and then the 5-year note. I think the curve can start to disinvert, either because we have economic strength and the forwards have to go up, or because we are at the end of we're getting a little bit of bout of strength here before the real weakness starts. And the Fed will actually have to pause and even ease at some point in a year or so. So I'm starting to move my buys in the yield curve for the first time in a very long time.
How do you parlay that duration call into credit at a time when people were talking about spreads being too tight, and then they widened by more than 100 basis points? If you look at over in the high yield space, at least according to some of the rating sectors, do you see this as a buy opportunity now, or do you see this as possibly pointing to more risk?
If the curve is going to re-steepen, especially if the front end could rally, it's not a great time for it's not the optimal time for credit. Right? We had the tightening since October. It was very meaningful. At this point in the cycle, you buy quality and you come back to riskier things later on.
So how much are you looking at the potential for perhaps a 6% bogey, 7% bogey on your annual returns based on this once-in-a-generation lifetime where you are going to see higher yields, but you can lock them in and ride the whole way down?
Well, listen, Lisa, first we have to stabilize, right? So there's no reason if we go down, as Tom said, another 4%, that'll put us down pretty much 4% for the year. If we earn our coupon back, we'll end up flat. So you're not going to...
There's a bond math. That's a famous Morgan Stanley bond math right there.
But if you can find some of these values and you can be patient and you can get in at good levels, yeah, listen, hey, if you buy a 6-month bill close to 5%, you're going to make, I guess you have to do it twice, but you'll make 5% for the year. So you're not that far off. Yes, duration should help at some point. That point is not now. It takes a long time. The markets are impatient, but the Fed will tighten too much. They will start to ease, but we're just not. That's not the story yet.
Brian, let's finish on credit and sit there for a couple more questions if we can. I remember at the start of the year when high yield spreads were tightening up, they tightened to about 385. That was the tightest we've seen high yield spreads on a year so far. That was the morning, the same day that we got the payrolls report for the month of January. And I was speaking to Gershon Distenfeld of Alliance Bernstein, and I said, this makes no sense. We've got sub 50 PMIs and spreads are tighter, not wider. And he said, John, it can go one of two ways, not just one. He said, either spreads need to widen or the PMIs are going to improve. And the PMIs have improved. They've got better. We're no longer sub 50 on the S&P Global PMI on services. Now, Brian, I wonder, good news has seemed to be bad news for the equity market. What does it mean for credit?
I think if you take a longer term view, the credit markets are just ahead of the data, right? That's one of the problems the Fed has, is they keep pointing at data that are lagging indicators. I think the high yield market was a great indicator that things were going to bounce, that we had gotten too pessimistic. But the problem is, on a longer term basis, the Fed has one mission, right? They want to raise cash rates high enough so that you buy a 6-month bill and not the high yield market. That is a tough headwind, right? It's not that they want unemployment. It will cause unemployment to go up. They don't want the economy to crash, but they need things to slow. So I think it is a tough headwind. Does that make good news bad news? I think to some extent, yes. It means that the Fed it's going to be harder for them to stop raising rates if ISM bounces. And if the high yield market keeps widening, I think it tells you they're going to raise rates until it hurts.
Brian, is that still the game? Does it come down to that, what you just said, that this Fed wants people to buy the 6th month and avoid everything else?
I think so. I mean, they've had every opportunity to do something different, right? You could re-steepen the yield curve. You could increase quantitative tightening by selling assets. If you wanted to change the math, the Fed could do it. You could point to a different indicator, but they haven't. They've been very simple in their, maybe they've been overly nuanced at times. But the idea is it takes a long time to stop inflation. It's psychological. The only way to do it is to make cash rates very attractive, invert the yield curve, and wait. And so for all the noise since October, I'm not sure that a lot has really changed.
Well, cash is attractive, and the yield curve is inverted, that's for sure. Brian, we enjoy it, as always, to catch up with you, sir.
That's
Brian Weinstein there of Morgan Stanley Investment Management. Bit of a clinic there, TK, on fixed income and some of the opportunities for everyone right now.
Really, really important, John, and I can't say this enough, folks. Weinstein is hardcore. This is a Morgan Stanley tradition of looking at looking at individual bond versus spread. Obviously, they look at spreads because that's the way Wall Street talks. But the answer is our listeners and viewers that own a bond, maybe they look at yield when things are comfortable, but when things are a bit sweaty, this is Liz Goldenberg 102. They look at price, and the joke is price down, yield up. There's nobody worried about the 3-month, 30-year spread here. They're looking at their portfolio at the end of the month and going, as Brian said there, wait, we go down 4%? That's a coupon for the year.
Well, the price damage last year was brutal.
Oh,
absolutely
negative
brutal.
18%.
In credit, it was...
I mean, it was great. The triple leveraged all cash GPT fund, we were wide of that.
How's that working out?
It's working out great. The GPT function is really added. We added 2 basis points off that.
The banks are banning it now.
I was going to say, JP Morgan doesn't like your fund that much. I think that they are banning ChatGPT
they didn't.
and the use of that.
Do not allocate to TK's fund.
They didn't get a distribution agreement.
Futures turning a bit negative.
Agreement with them.
Down 0.2 on the S&P.
Can we get Brazil? They said no.
3-day losing streak on the S&P 500. Will we add to that? This is Bloomberg.
On the Dow as well.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's release of Federal Reserve minutes are likely to show how much support there is for larger interest rate hikes. The question is whether more officials considered a 50 basis point hike at the last meeting. And the tone could hint at how policymakers are interpreting recent data on inflation. The European Union has slashed its natural gas demand this winter by almost a fifth. And that beats a voluntary 15% goal that was aimed at helping it survive the winter with lower gas flows from Russia. Finland saw the biggest drop. Usage there was cut by more than half. Bloomberg's learned that JP Morgan Chase has curbed its staff's use of ChatGPT. The chatbot has created buzz about its potential in everything from writing poems to creating stock portfolios. But there have been reports about inappropriate interactions and errors in its results. In China, authorities have urged state-owned companies to phase out using the 4 biggest international accounting firms. It's a sign they're still concerned about data security. The firms include PricewaterhouseCoopers, Ernst & Young, KPMG, and Deloitte & Touche. High vehicle prices and pent-up demand proved profitable for Stellantis. The parent of Fiat Chrysler and Peugeot unveiled a share buyback of as much as $1.6 billion after forecasting another year of double-digit returns. And they're offering some relief to car buyers, too. Stellantis expects vehicle price increases to slow this year as chip shortages ease and production picks up. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, where did that hairdo come from, and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
What about what happened in Europe? That's the big one for oil. Really big warm weather shock drove gas prices down sharply, particularly in Europe. We have TTF, dropping all the way down to 49 euros a megawatt hour right now. Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
Remember when we said we needed a meteorologist last year?
Yeah,
just to forecast crude and gas and maybe even the equity market in Europe and the economic data as well. That was Jeff Curry there of Goldman Sachs. Crude right now, and let's take a look at oil together. Oil's down for 6 straight sessions. That's the longest losing streak on WTI crude since December 2022. So it's the longest losing streak of the year so far. Crude right now, $75 and about 50 cents, Tom. Down on the session by about 1%. I have to say over the last 6 sessions, it's not a brutal amount of losses. We're down over the last 6 sessions by about 6%, but certainly the losses are there for all to see.
They're there to see, and we'll get to this with Amrita Sen, but I think that all you can do and everyone knows it's the single toughest thing to predict. I think there's a lot of good academics on that as well, is listen to smart people. And to go from Ed Morse of Citigroup yesterday to our conversation there with Dr. Curry of Goldman Sachs, and then to Amrita Sen. I mean, this is all you can do is talk to adults that actually know what they're talking about.
To be clear here, Jeff was talking about the retreat we've seen in commodity prices, including natural gas, but ultimately, he still sounds pretty bullish when you go through his recent comments, Tom, to Bloomberg TV, suggesting the China reopening, A-OK, we're on course.
That's the core issue, isn't it?
Without a doubt.
Christian Malik at J.P. Morgan, Lisa, it's a 100-page missile a year ago. And there it is. They say it's about, and you had Jay Pulaski on, and you're the hour you have the Faro hour. You had Jay Pulaski on the Faro show. Thank you. And it's Pacific. It's a Pacific Rim redo.
The Malik-Morse distinction, and I think that's really the question. How much do you start to see the sort of renewables come in and reduce demand even in an economic recovery? And that I think is sort of the distinction between the bulls and the bears right now.
Let's drive it forward right now, and this is a joy. Amrita Sen, all of these strategists, folks, take a different view. And what I love about Amrita Sen, off of maybe Jeff Curry and his microeconomics at Chicago, she really looks at the dynamics of supply and demand, co-founder and head of research in energy aspects in London. Amrita, just simple as I can, and I don't need a central theorem lesson, but what's the correlation of your world right now to the stock and bond upset we're living? How does crude correlate?
Great question, Tom, and as always, thank you for having me. Always a pleasure. I mean, look, I think part of the problem is crude oil specific fundamentals are not particularly strong. We've built a ton of inventories. We've had bad weather. We've obviously had, or we do have right now, a lot of refinery maintenance. And that's why right now crude is pretty much at the mercy of, exactly like you're saying, the bonds and the equity markets. And this is why the 6 sessions we've seen that's been trending lower. And this is something we called for just recently as well, that crude is probably going to be at the mercy of macro headlines. And by the way, now even good news is bad news. You would think, oh, strong labor market in the US is actually really bullish for gasoline demand. But guess what? No, now the fears are that means the Fed's going to raise interest rates. What does it mean for the future of the US economy? So it is very, very problematic for crude until fundamentals pick up.
Well, when the fundamentals pick up, we do have China reopening. What is your x-axis on the China reopening? Are you waiting for May, or are you waiting for May of 2024?
No, I'd say May of this year. We've got 1 million barrels per day baked into our numbers of Chinese demand growth. I think the problem, of course, is that China, again, just coming out of the Lunar New Year holidays, that it too has maintenance. Look, we are hearing right now of potentially very low Chinese product exports coming out in March. We need to confirm that. It's still very early stages. Will be the very first sign that, yes, domestic demand is strong. It will take a little bit of time for this to percolate through. I would say right now the oil price is actually focusing and factoring in a Western recession, and it really hasn't factored in the China reopening.
Well, how much does this really factor in the fact that any kind of China increase in usage will be funneled into some of the renewables, into a lot of domestic production, whether it's wind or solar? This is what we were talking about with Ed Morse, that kind of substitution, for whatever reason, is diminishing the demand, even in a stronger economic profile.
Absolutely the case in the longer term, right? But right now, we know we've got more than 1 billion people who've been locked up for 3 years, and we're already seeing it in the jet fuel numbers. Just China's reopening alone can lead to 400,000 barrels per day of additional jet fuel demand. There is no renewables to replace that, right? So there is an enormous amount of pent-up demand. We've seen this in the West, and I don't want to complicate the story. The renewable story is absolutely there for the long term. EV sales in China are skyrocketing. We have that in the numbers. But that doesn't take away from the fact that gasoline and jet, which is basically used for mobility, we are already seeing very, very strong demand. People are going to fly, and you are going to see some very strong demand numbers out of the region.
So good news, bad news, it doesn't really matter what it is, but the macro has been oil prices lower. That seems to be sort of the trend regardless. What's going to shift that and get prices above $100 a barrel like you expect?
I think we have to wait really towards kind of second quarter, end of second quarter and into the second half of the year. And for me, the fundamentals really have to tighten up. The stocks we've built will need to be drawn down, which we are expecting counter-seasonally from the second quarter of this year, not before that. I think right now, and we've got a big gathering in London next week. All the traders and producers and consumers are coming in for IE week. I think you're going to get a lot of kind of talk around this as well. So I'd say after that, like you're really into Q2.
Amrita, the three of us really look forward to seeing you there on an all hydrocarbon week for Bloomberg.
Oh, nice.
Surveillance is well.
Is that on the list, is it?
It is.
Done. Deal. Yeah, absolutely.
It is. Do you know you can't get a drink at the oil week in London unless it has an umbrella in it?
Is this the same as Copper Week or whatever it's called?
It's like Copper Week, yeah. But they're spread out.
LME Week.
LME.
Can I get to this quote from Morgan Stanley this morning? So they cut their forecasts for crude for 4Q and 2024 to about $95 a barrel from 110. And this was the quote, Amrita, from them. The new estimates reflect stronger demand, but also higher Russian supply. Now, there might be some people who aren't in this commodity market who would turn around and say, well, Russian supply, why has that affected the market? What is that all about?
Look, we've also raised our Russia supply numbers because Russia is being able to place more barrels than we had initially expected. Again, par for kind of doing forecasts in an extremely uncertain world. That's absolutely fine. However, I go back to Chinese demand growing by 1 million barrels per day, and SPR, we do not have 1 million barrels per day of SPR hitting the market. That's a 2 million barrels per day swing. So even if we assume Russian production is flat year on year, i.e. we don't lose any Russian production, we will lose some, but just assume we don't, it is still a much tighter market just from China and SPR alone.
So that's the crude call. I just got a message from a Bloomberg subscriber, and it just said, forget WTI, natty, just wow.
Yeah.
Can we talk about natural gas just briefly, Amrita?
Yeah.
So what's behind that move?
Weather. I mean, like you said, you needed a meteorologist in terms of, we need weather forecasters. But look, Europe got very lucky, and of course in the US as well, just how warm it's been Jan, Feb, and even our March forecasts have again raised just the amount of natural gas we are backing out as a result. We think natural gas prices will have to fall to about $1.75 before you actually kick in shut-ins in the US. So still a little bit more to go. But yeah, it has just been brutally warm.
What a change, eh? Natural gas falling below 2 for the first time since 2020, and Amrita's looking for a further move lower. Amrita, this was great. Thank you. Amrita Sendev, Energy Aspects.
Thank you.
On the weather, do you want the weather? Okay. Across the contiguous 48 states, January was the 6th warmest on record. The 6 New England states, as well as New Jersey, were warmer than ever recorded, according to the U.S. National Centers for Environmental Information. New York, Pennsylvania, Indiana had their 2nd warmest January in data going back to 1895.
And somebody was on and said you could go out I-80 to Wyoming with no snow, which I can't imagine. There was a genius at A.G. Edwards years ago. He was going to play for the Cardinals. His name was Al Goldman, who came on every day and gave strategic wisdom and was very gracious. And once he said to me, Tom, the correlation of hydrocarbons is 74% with what the weather is at the subway stop of New York Stock Exchange.
So here's
74%.
I've heard that before.
Some graduate student had done some research on this.
Okay, not to go back to this, but this is the sort of conundrum wrapped in an enigma part. So here's the thing where you get low natural gas prices, lower utility bills, that gives people more discretionary spending to go out and shop, right? So you have this sort of distortion of weather that affects everything, and at what point does it reverse, or at what point can you kind of count on it as being real versus weather-induced distortions?
Is it not real?
Well, I guess that's not the right way of phrasing, but, you know, not sustainable. I think that's probably the better way of saying it.
We'll see. I'm always happy to trade a cold winter for a great summer. What do we get in the summer now?
Just incredible heat and humidity.
I'll take that.
Really?
I'm fine with the humidity in New York.
Really?
Yeah, I'm all right. I grew up with rain every day. We had 1 week of summer.
Look at
But
you.
you get a week
You're
in
like
July
Tom
or August.
with cold weather. This is you with humidity.
I'll take the heat.
It's ridiculous.
Some hot weather, Tom. That's nice in the summer. That's what summer's about.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Let me talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to Starbucks a lot.
And
yes.
When you check in, do you have to wait in line like everybody else?
Yes, I wait in line like everyone else. That's an important part of the process, to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink, can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company, and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This rally's been very fundamentally driven. It's been this easing inflation and interest rate shock and less bad growth data.
The economy is going to stay strong in the first half of this year, probably into Q3. You know, the consumer in the US is still in a good place.
More broadly, we haven't seen a recession. We see consumption still growing very, very strongly, very robustly.
I think we've skirted recession this winter.
We will agree that Fed is going to continue to raise rates. That's not the issue. The issue is how long will they stay up?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Coming off the back of the worst day of the year for U.S. equity markets, live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures right now unchanged on the S&P. We closed at a new high for the year on a 2-year yield in yesterday's session, and the highest level, Tom, going all the way back to 2007. We closed through 470.
4-day work week, or maybe we're off the radar here, the minutes today and all that. I get, John, but I'm going to suggest there's a lot going on here, and it's a yield curve lift, and it's a signal here of a change that I would suggest very few people modeled in.
Off the back of better data, Tom.
Unexpected.
As you mentioned, TK, the whole yield curve shifted higher by 10 basis points plus across the whole of the curve. The question we've been asking over the last couple of weeks, looking at the January boom data, is whether February confirms that. We've got a sneak peek a little bit earlier yesterday, at least from the US PMIs from S&P Global. Now, I don't think it's conclusive, but certainly it was heading in the direction that it might confirm what we saw in January.
Not conclusive, but strongly suggestive of incredible strength, particularly in services. And this, to me, was interesting. It climbed above the contractionary level of 50 for the first time going back 9 months. Suddenly, we're in expansionary territory again for services. And there was a spending survey for consumers that came out this morning that I thought was really interesting. Basically, people are taking money out of some of their basic goods items and putting it directly into flying around and staying in hotels. I mean, that's basically what you see, and it's confirmed in every data that you get.
Let's stop. This is really important. I dealt with this weekend, and I think the two of you have dealt with it more than me. Work from home has changed all these service sector things we talk about, because people are traveling, because they're not modeling out, we got to get out of here Friday at 4 p.m. or 5 p.m., dash to where they're going, and Sunday at 12 noon, they got to come back. John, they're taking off Friday and Monday.
I know.
I mean, this is more going on.
Lisa was talking about the 4-day work week. For some people, is it 3?
I don't know. I think it is for me this week. I think I'm taking off Friday.
You're taking a 3-day
work week.
3-day work
week. No, did you see that UK is going to keep a 4-day work week in place? They did an experiment, and all the companies are like, we're good. We're going to keep it this way.
That works. Productivity's up, right?
Yeah, exactly.
You know, it makes sense. We can't do it, though, because markets are open 5 days a week. We should lobby the exchanges to bring that in.
Work from home exchanges.
It will work. More people will come
We'll
to
be
work.
on Zoom in our pajamas. Like today's our,
Is this part of the lobbying effort? It begins right now. Okay. Let's whip through the price action for you on the S&P 500. Totally unchanged. Coming off the back of the worst day of the year on the S&P. Losses of more than 2%, pretty much across the board. 3-day losing streak on the S&P 500. Still up on the year to date on the S&P and the NASDAQ. But the moves we've seen in the bond market have been absolutely phenomenal. Tom, higher by more than 10 basis points in yesterday's session, coming in a little bit right now at 394.
Well, coming in at 394, but we got to 396 here, and we I had the banner on the mortgage market, John, in the last hour, and I'm sorry, the mortgage rate is buttressed, bank rate 30-year mortgage, John, is buttressed up against 7% again. Tell me a 7% housing market doesn't change the equation?
Who's going to buy a house with that kind of mortgage rate, Tom?
Who can afford to? How much value is taken out? You look, forget about 3%. How much value is taken out in any kind of urban area from 4% out to 7%? Do you lose 125 buyable power or 175 buyable?
I saw some of the latest housing data, Lisa, housing sales, and it said housing sales stifled by higher interest rates. And I thought, I'm not sure that's the right way of framing it. I think the right way of framing it is by saying this whole housing market is stifled by pandemic interest rates. Nobody wants to move.
That's a good way of framing it. Basically, if you've got a locked-in mortgage of 3%, why transfer that into a 7% mortgage, even if you can get a lower price? And this is a reason why perhaps you're getting stasis in the housing market, albeit not necessarily the declines in the actual prices that a lot of people were expecting. Here's what we're watching today. 8:45 a.m., President Biden is meeting with the leaders of the Bucharest Nine, as well as NATO Secretary General Jens Stoltenberg. We are just opposing it with the meeting that already happened with Wang Yi of China, the top diplomat there, meeting in Russia with the counterpart to Vladimir Putin, with Sergei Lavrov. How much do we get this sense that there is this ongoing Cold War that is deepening, or can we get some sort of softening? And it really matters from a market perspective, because we're going to get a business case for this. At some point, businesses are going to think twice about extending their relationship across borders in this connection. 2 p.m., we get Fed meeting minutes. I care. Perhaps Tom's not going to read it or do the Tom Keene skim, but a lot of people are going to dig into how they emphasize the reaction function, how they emphasize the potential for ongoing rate hikes, albeit even at 25 basis point increments. And at 5:30 p.m., we'll get more color perhaps on that. New York Fed President John Williams is speaking in a fireside chat titled Taming Inflation. And honestly, I'm curious about what they say about the importance of getting back down to 2% in terms of a longer-term inflation goal. John, this matters in terms of understanding how far they will raise rates and how long they will hold it if people believe that this momentum could last, if you get a no-landing type of scenario.
Let's talk about that no landing right now. And Lisa, thank you for that. Bramo with the day ahead there. No landing. So this is January 9th, 2023. There will be no landing for the economy this year. That was Ed Yardeni at the start of the year. Ed Yardeni, president of Yardeni Research, joins us right now. Ed, you, Neil Dutta, and much later on, Torsten Slock of Apollo, all talking about the same thing now. Ed, why did you see that coming earlier this year? And are you seeing more and more confirmation of that view?
Well, I guess my contrary instincts came out at the beginning of the year. Everybody was talking about a recession. Some people said it's 100% inevitable. And they had some data supporting them. The Index of Leading Economic Indicators, which has an awfully good track record of forecasting recessions, has been screaming a recession since it peaked in February of last year. And typically, it gives you a one-year lead time. So we should be in a recession right now, and it's just not happening. But I also looked at the consumer, and the consumer data just continue to show that you don't want to bet against American consumers when they're, well, let's put it this way, when they're happy, they spend money. When they depress, they spend even more money.
And it's still a term quite loosely defined, so maybe we can tighten that up just a little bit now. For a lot of people, it just means that the economy doesn't come down. We keep churning out great GDP prints, great payroll stories, all the above. But also that inflation remains sticky. Now, is that the element you also forecast for this year?
Well, I think that, prior to the release of the January's batch of no landing indicators in early February, I think we were mostly debating, all of us were mostly debating whether it was going to be a soft landing or a hard landing. Nobody really spent much time talking about no landing. No landing, in my mind, means that the economy is growing 2.5%, maybe more this year. The soft landing, I think, is more like 0.5 to 1%. The hard landing is a traditional recession with negative numbers of 1, 2, 3, 4%. And I think that's what's changed. And that kind of, as you said, that gives you, promotes the no landing scenario to something that we need to debate. And there's actually two versions of that. There's the inflationary one, which I think is what the market suddenly started to worry about. And then there's the disinflationary one, which I think seems like a stretch, but I think it's possible.
Oh, we're going to have Ed Hyman on. I'll tell you, folks, Ed Yardeni and Ed Hyman on with Bloomberg Surveillance is what we're all about. Dr. Yardeni, I want to go to what all your no landing means for nominal GDP and the animal spirit of corporate America. Whether you get your two scenarios, you get an okay to, dare I say, a robust nominal GDP. What does that do to corporate America?
Well, corporate America continues to have very good revenues growth. Well, when I say that, it means that it's positive growth, and part of that is inflation, but part of that, as we see, is real economic activity is doing better than widely anticipated. So I think that this kind of gives some credibility to the more bullish, more upbeat outlook for earnings that I've been talking about, which is $225 a share for earnings this year for the S&P 500 and $250 a share next year. And those numbers are on the spectrum of earnings outlooks is among the more optimistic ones. There are plenty of people talking about even now 200 or less for earnings.
Well, people are looking at margins, right? So revenue growth can be really robust, but what we saw yesterday from Walmart and Home Depot was margin erosion as they're facing higher costs for their workers, and they're also not able to pass those along. Is that going to be sector specific, consumer based specific, or is that going to be broad-based margin pressure that you think just is already priced in?
Yeah, it's interesting that you asked that because for today, for our research, we're working on today on a story on profit margins, and we looked at all the data using forward profit margins based on analysts' consensus expectations for revenues and earnings. And what we're seeing is it's pretty widespread. Everybody has some amount of labor that they need to operate, and as a result of that, I think there has been a squeeze. But I think some of it is pandemic related. I think we're kind of getting back to a more normal labor market, believe it or not. I think labor is going to find that there is a limit to the extent to which wages are going to be raised by companies. And I think that's because the companies are starting to run into resistance from consumers to price increases. So that's why I'm a disinflationist, and I think that inflation can come down even if the economy doesn't land.
Interesting. Ed, thank you, sir. Ed Yardeni of Yardeni Research. Ed, credit where it's due. Great call at the start of the year. Tough call on the equity market, but great call at the start of the year on this economy for 2023. And we'll see. Look, I think it's too early to draw conclusions off the January data. We'll look for the incoming data and incoming information for the month of February. We've had one read on that, Tom, and the PMI slightly confirming what we saw in January in that boom.
Are we in a news vacuum on economics? I mean, essentially, is all this upset day to day because we're all addicted to, you know, CPI Tuesday
and payrolls Friday,
conundrum and enigma Wednesday, might I point out?
Home purchase application Wednesday.
That works.
Yeah. Does it though? Yeah, they dropped to a 28-year low. This just came out.
This is a huge deal.
Yeah, just to give you a sense. I mean, we were just talking about
7%.
Yep.
We're at 6.96. I don't know how you do it.
I wonder if we start to see, and someone messaged me about this moments ago, in the UK you can port your mortgage to another property. I wonder, Lisa, if the banks are going to be under pressure to do a lot more of this.
That's actually what people are talking about. That's the next step.
If they want the fees.
Exactly.
You know,
yeah,
just let people move with the existing mortgage. Totally.
Can I ask you a question?
Sure.
Can I get in an Alfa Romeo?
Would you fit?
Small? Would I fit in an Alfa Romeo?
You could get a big Alfa.
You
could get a big Alfa. Do you want to talk about that next?
Yeah.
An electric Alfa. I like Alfa. Beautiful cars.
Italian.
Future's up a 10.
Like a Lancia.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. White House aides say President Biden's trip to Poland underscored the massive miscalculations by Vladimir Putin in Ukraine. They say it also highlighted the costly investment in democracy that the U.S. and its allies have made. The president told a crowd of about 30,000 that Ukraine will never be a victory for Russia. China's top diplomat calls relations with Russia solid as a rock. The remarks by Wang Yi come as Beijing is trying to portray itself as a neutral actor that can broker peace in Ukraine. Wang met with Vladimir Putin in Moscow. Meanwhile, the Wall Street Journal says China's President Xi Jinping is preparing to visit the Russian capital. We may get a sense of how many Fed policymakers saw the case for a larger interest rate increase at their last meeting. The central bank will publish minutes of that gathering at 2 p.m. New York time. They may also show whether Fed officials anticipated the need to take rates higher than previously thought to tame inflation. The Biden administration will cut mortgage insurance costs for some first-time home buyers. The The program will be unveiled today, and borrowers with mortgages insured by the Federal Housing Administration will see their fees cut by about $800 a year, or 0.3 of a percentage point. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. This week, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage starts February 23rd. Bloomberg, your global business authority.
U.S. consumers are not really being hurt by high rates. In other countries, as rates go up, that hurts the consumer straight away. What we're seeing coming through on the data here, it's not happening here, particularly when you have such a strong labour market.
It was Lee Ferriger, State Street. He was phenomenal. He was brilliant. Ultimately, the point from Lee is pretty clear, that he believes in long and variable lags, Lisa. They're just super long, like decade-long
And
variable
that's
lags.
just going to keep kind of pressuring things.
Because of the nature of the mortgage market. We saw a big move in rates yesterday. 2s out to 30s, yields up across the curve by more than 10 basis points. We're retracing just a little bit of that. Yields just a touch lower in the bond market, on the session at least, and backing away from year-to-date highs across the whole of the curve. If you look at the equity market, equity futures shaping up as follows on the S&P 500, positive 0.8%. Yields coming in a couple of basis points. TK 10-year, 392.92.
It's going to be interesting to see, John, this is an important interview that we're going to do right now. I want everybody, particularly in America, to stop. How about an automaker with a double-digit return? Stellantis is the pieces picked up from the car I always wanted as a kid, a Citroën, Peugeot, and the rest of it, up 21% per year from 2014. John, Renault, negative 3%. Volkswagen up 3%. And the U.S. manufacturers, not much difference. It has been an extraordinary path as they've picked up the pieces.
I want to be clear here. You wanted a Renault when you were a kid?
A Citroën. I just thought the Citroën was, some
My mom had a Renault 5 and my dad sold it and she was distraught.
Well, this is what we're going to do.
That went down so badly in my house back in the day.
Yeah. For Americans, this is important because Lancia now is our new renaissance at Stellantis. And the leadership there is Carlos Tavares. And as John Farrow grew up rooting for AC Milan and owning a Lancia.
A Lancia Delta.
A Lancia Delta.
Car.
This is the design and character that makes a pulse goes. Carlos Tavares joins us now, Chief Executive Officer at Stellantis. And thank you so much for inviting us at Bahrain for the Formula One. We really, really appreciate it. I got to drive the forward conversation off of earnings and the good news of your company today, which is you're looking for a warm spot in 2026. You had a joint agreement with the Swiss. They're moving on to Audi, fine. And the great mystery in Formula One is what Carlos Tavares is going to do to get into the new age of Formula One. Can you advance that story this morning, sir? What have you learned in the last couple weeks, what your Alfa Romeo team will do?
Well, first of all, I would like to remind you that we have 14 brands. Of course, Alfa Romeo is very warm to our hearts. Fantastic brand equity, fantastic history. As you know, our motorsports programs are focused on the 24 hours of Le Mans right now with the hybrid technology and the Peugeot brand, and also on the single-seater electric races with the DS Automobile and Maserati. Maserati is now a contender of the world EV single-seaters, and that's where we are putting the focus. Alfa Romeo will come later. Alfa Romeo will have certainly a motorsports program at one point in time, and we still have time to discuss this as we are still in Formula One for some time, and then we will unveil the program for Alfa Romeo. But it's too soon to unveil that, and I apologize for that.
Okay, well, we're going to do it later in the interview. Carlos, help us here with how you bring the romance in your success of since 2014. How do you bring that over to EV? How do you bring Alfa Romeo and all you've done there over to electric vehicles?
Well, that's very simple. Actually, you just have to drive the cars. If you drive the cars, if you experience the takeoff acceleration of an EV, if you experience the smooth ride and the improvement on the noise and vibration, if you experience the very low height of the center of gravity, to put it simply, an EV car is a better car. Because it's a better car, you can easily bring it to Alfa Romeo with extended technology to ensure that the customer drive is even more exciting and pleasant. This is exactly what we are doing, is extended sportiness for the Alfa Romeo brand with better acceleration, with better drive, with a smoother ride. And by the way, this is exactly what we do with e-muscle American cars with Dodge. We bring more muscle, we bring more burnouts and more donuts with the electric technology. It's just a better car.
Right. Lisa, what's so good about this is you can drive down Central Park West in second gear in an EV Alpha, and the noise you can make with that, it'll be just killer.
Yeah. Well, I'm not an expert in the fake noises that you can create in your silent EVs, but I do want to talk about the Ram and Dodge brands because we're talking about the U.S. and we're talking a lot just generally about margin pressure, and yet you recorded some of your biggest margins ever with the sale of these types of vehicles in the U.S., and I'm wondering how long that can last, given that there's starting to be some pricing pressure on the margins.
You are right to ask that question. In fact, first of all, we should just recognize that the employees of Stellantis, starting with North America, have done a stellar job in 2022, facing all the external headwinds that they had to face. Now, to your question, in the near future, it's going to be an exciting period where everybody is going to try to hold on to a significant pricing power, despite the rebalancing between supply and demand, which is, of course, ongoing and already there. So that rebalancing on supply and demand will put pressure on the pricing. But on the other side, because of the interest rates, we see some cooling in the economy that will bring more cost reduction on some of the raw materials, eventually starting with steel, which means from one side, pricing power is going to be under pressure, but you have the technology, you have the appeal of the products, you have the new models that are coming in. And from the other side, you need to run fast in reducing the cost at a faster pace than the erosion of pricing power. That's going to be the name of the game for the next year. And we are in the race. We are in that race. And I think that we'll see within 1 year who is going to be the winner of that race. But that's exactly how things unfold in front of us for the next quarters.
Carlos, does that mean job cuts?
At this stage, the picture is about how do you absorb the cost of electrification. You see, you can see in many places of the world that the customer has not yet totally recognized that EVs are a better car. And we see that when there are subsidies to erase the cost of electrification, then the customers buy EVs. As soon as you remove the subsidies, and you have this example in Germany, you have this example in Italy, then the consumers stop buying EVs because they are not affordable enough. So the challenge for the industry in the next 3 to 4 years is to absorb the additional cost of electrification to protect affordability and make sure that middle classes can buy pure EVs at an affordable price, which means that the transformation of the industry is just starting. In fact, we are live now, transforming our company in a way that needs to be reasonably deep because new technologies are in, software platforms, many electric components, autonomous vehicles, all of this costs a lot of money. And at the same time, you need to bring affordability to the middle classes, which means that if we do not do our homeworks in terms of productivity, then in that case, you will not be able to compete because some of the new entrants will show you that your cost competitiveness will not be enough. So do we need to make sure that we protect our companies by doing more cost competitiveness? I would say, of course, yes. I would like to remind you that Stellantis has a break-even point, which is the benchmark of the industry, as our break-even point is at 40% of revenues. 40%.
You're taking down the clock a little bit longer with a very long-winded answer, so can I ask it again with 40 seconds left? Does that mean job cuts?
It means that we are not excluding anything from the task of absorbing the cost of electrification.
Okay. Carlos, thanks for your time today.
Just wonderful.
Enjoyed that conversation.
Thank you,
sir.
Have a great day. Bye.
Carlos Tavares of Stellantis. That's going to be the hot button issue for the European manufacturers, Tom.
Huge. And
Massive.
U.S. manufacturers are dealing with it as well. But what's so
Massive.
important is carry it over to the tensions in China. That could have been a 2-hour conversation.
You want to offer EV credits and the transformation of business that's going to lead to job cuts in the manufacturing business in autos. Let's see how that goes.
And there are fewer employees required for EV manufacturing. So this is an actual logical consequence.
Futures right now, positive, 0.2. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Three-day losing streak on the S&P 500. Equity futures shaping up as follows. We look to snap that up a couple of tenths of 1% on the S&P. On the Nasdaq, up 0.4%, coming off the back of the worst day of the year on equity markets. Year to date, the S&P up something like 4% now. The Nasdaq up close to 10% still. The two-year yield, get to the bond market. 2s, 10s, 30s look like this. The two-year yield yesterday, the highest going back to 2007. Yields come back in this morning by 6 basis points, 466.43 after closing through 470 in yesterday's session. We were inching closer and closer to 4% on a 10-year, now 392.34, down about 3 basis points there. But Tom, to your point, the whole curve yesterday, 2s out to 30, shifted higher by 10 basis points or so.
And to get a little, I hate the spread market analysis, but let's go there right now. We had a negative 92 basis points, and the difference in yield between the 2s and the 10s spread, and that has gone from negative 90 to negative 74, which is an indication of that shift up in a flatter yield curve. Lisa, did I do okay there?
You did great.
You got a pass. Well done. Flying colours. I want to finish on foreign exchange briefly. And take a look at euro dollar. I just knew we'd move on too quickly. I want to squeeze this in.
Why do we leave Tavares behind us here?
You want Carlos to carry on talking?
I just want to get to Bahrain March 3rd or 5th.
He'd still be answering that question about job cuts.
And you came back. He said, well, that's American. He said, the British kid's becoming American.
No, just keep on going. Exactly. Still going now. He doesn't realise the interview's finished. Anyway, can I go back to euro dollar? I knew this would happen.
Please. Thank you.
106.41. So the high of the year was 110.33, and it came the day before, the day of the ECB and the day before the jobs report. And this is what makes the Fed minutes really dated a little bit later. If you go through all the data points that we've had since that Fed meeting, whether it's the payrolls on that Friday, what we got 517,000 and unemployment dropped to 3.4%. If it's the big jump we saw in the ISM Services Index for January, CPI not dropping as quickly as anticipated, PPI an upside surprise, retail sales month on month with a 3 handle, and a first look at the PMI for February, Lisa. Is the boom time of January confirmed by the February data? This is how stale those minutes are.
It's a conundrum.
Wrapped in.
Honestly, I'm going to keep saying that. And honestly, the earnings that are coming out just confirm that view of confusion, because we just got TJX, which is a discounted retailer, and much better than expected results across the board. You saw net sales come in at $14.5 billion versus about a $14 billion expectation. You saw the EPS for the fourth quarter, 89 cents versus 78 cents year over year. So all of this really positive. Those shares up, not that much, about 0.5%, but really it comes in the heels of negative outlooks with respect to Walmart and Home Depot. It's a different buyer base.
And a listener here, Al from New Jersey, thank you so much for emailing in. He was in a Marshall's in New Jersey yesterday and said it's bubbling. And the difference here, Lisa, is this is not Home Depot. This is not, some big platform. This is a grinded out closed company at discount. And the comp sales beat is really impressive.
Indeed. Should we look at some of the other earnings that I've been
Please
looking
do.
at? Okay.
He's never been to a TJ Maxx in his life.
I have gone to lots of TJ Maxx's. Have you ever been?
In the UK, it's TK Maxx.
Really?
Found that very confusing. When I moved here.
TK Maxx, it's got your name all over it. Okay, let's look at some of the others. Overstock.
So true.
Overstock, I'm looking at that. Those shares down as they report net revenue for the fourth quarter that missed the average analyst estimates. Those shares lower by 8.2%. Very tied to the housing market. So how much is that part of what's going on? Also, do you remember when they had this sort of like crypto aspect? They mentioned that they're going to accept cryptocurrencies, and then their stocks boomed during the pandemic, and now it's the other way. Coinbase shares are a little bit higher. Basically, people, I guess, optimistic that they can continue to generate some gains with the observance of Bitcoin, although it was down a lot before, so I can't really make much of that. And CoStar Group, talking about that lack of sales. This is a commercial real estate company, down 14.4%, dealing with the potential declines in revenues and seeing pretty negative forecasts going forward. This, to me, is fascinating, considering the fact that fourth quarter revenue tumbled 75% for that company compared to the year earlier period. So, Tom, you want to know where it is?
Yeah.
That's where it is in terms of housing market pain.
Do you have Intel up there yet, Lisa? We're sort of doing this in real time this morning.
I don't.
Intel was stunning, and might I add, historic headlines this morning. They reaffirm their Q1 guidance. Help me, folks, here. I'm reading this for the first time.
Cut the dividends,
That's how
Tom.
fit. They cut the dividends substantially from 36.5 to 12.5 cents. There's the usual McKinsey babble. I'm using that because McKinsey's in the news as well. Something about 5 nodes. They're gonna do something with some strategy. But this is an iconic company, Lisa, that's really challenged.
Yeah, and NVIDIA is reporting after the bell. What I find interesting is the stock reaction isn't much. They cut their quarterly dividend dramatically, and the shares are lower by 0.3%. Are people saying this is a good thing? Put that money toward other things, and perhaps this is the kitchen sink. Didn't we say that the last time they reported earnings?
Intel, 6% per year for the last 10 years. I mean, the answer is it's been a train wreck from, I don't have the stock price in front of me, I'm going to say from 65 down to 30, as a general statement.
Yeah, not a great earnings release either earlier this year. So there you go.
There you are. The way we do earnings, we do them in real time here, and thank you for watching us for earnings. Right now, we're going to shift back to bond market, which is where all of global Wall Street is focused. Marilyn Watson joins us now, head of global fundamental fixed income strategy at BlackRock. Marilyn, with your Cambridge parchment, I want to go to Dr. L. Arian of Queens College in the game theory that L. Arian is known for, which is there's at some point where you have to make a T decision. What is a T decision now for investors in bonds with the gyrations, with price down, yield up, the new push up, the shift up in the yield curve that we see? What is your T decision at BlackRock in bonds?
So now, I mean, as you say, with yields considerably higher than they had been, and I think, we've seen over the last few days again that the market is continuing to really focus on where the terminal rate might be in the US and elsewhere, also how long rates will remain elevated for a prolonged period of time. Also, when you look at the level of cash and what you can get for that as well, the decision for investors really is looking at the carry that you can get in your portfolio, the income to match your liabilities, the interest rate duration risk, and how you can really get the returns that you want and the income that you want. And this is versus cash, not versus risk assets anymore. So when you're looking at the risk-free market, when you're looking at the bond market, it's really focusing on getting very high quality, decent carry and comparing that to what you can get for cash and ensuring that you really are getting the returns that you want.
So at what point do you extend out into duration? We were talking with Brian Weinstein earlier, and he was basically saying, now is the time, start shifting out. We're seeing nearly 4% 10-year yields. Do you agree?
So we are slightly increasing our duration very tactically. I think now is the time we're starting to lock in a little bit more of that carry as we do, we're obviously continuing to see, very strong inflation data. Overall economic activity remains robust. But we are starting to get to the point where we do see the terminal rates on the horizon. We do think that the economy will slow and will continue to slow from here. And so I think now is starting to become the time where, it is maybe the time to sort of lock in a little bit more, but just being very cautious and being very cognizant that the Fed clearly is also being very, very data dependent, and it's made it crystal clear that it will, keep rates elevated and above the neutral rate for a prolonged period of time.
Tom mentioned Mohamed El-Erian, and he was on with John last week talking about how this Fed would have to choose between either torpedoing the economy or allowing inflation to rest at, say, a 3% level and not a 2% level. Do you agree with that? I mean, do you think that ultimately we will end with a higher inflation rate, perhaps over the next 10 years, than the Fed would like?
So I think the Fed has been trying to tread that very, very fine line, and it has obviously shifted down its increments from now to 25 basis point hikes. We think that we could see, potentially, a few more, but we think the bar is very high for it to actually step rates up in higher increments than that, because it is very cognizant that it doesn't want to torpedo the economy. Ideally, it will bring inflation down in a steady, sustainable fashion, but it doesn't want to torpedo the economy. The labor market remains very, very strong. And I think the Fed is doing its utmost to make sure that inflation does come down. And we do think that inflation will actually start to tick down in the second half of this year. But it is a very fine line, and the Fed is in a very, very tricky position.
Right.
But I think the Fed, of course, it doesn't want to torpedo the economy, and it will do its best if it can to bring inflation down to a steady point. But it is possible that inflation could remain, for a prolonged period of time above the 2% rate. And obviously, it's already shifted its target, to be more of an average position rather than a 2% position. So it could remain above 2% for a while.
Marilyn, away from your remit maybe, but I'm going to do this because Katie Martin in the FT had a great summary of the death and perhaps re-life of the 60-40 portfolio. And in it, Ms. Martin had a scattered out chart showing just how ugly 2022 was. Do you have a belief that bonds can be a constructive part of a diversified, allocated portfolio for the next 3 years?
Yes, I certainly think that bonds can have a very constructive part in a diversified portfolio. I think actually now, more than any period for a very, very long time, as you say, 2022 was a very poor year for both bonds and equities. And I think now looking forward, in this environment where we do see very decent yields, when we can lock in, say, very decent carry for high quality bonds with very little interest rate risk, then I think when you're looking at an overall diversified portfolio, you can get so much more now in the bond market. It's far more attractive than it has been for a very long time. If you go back, 2 years, 10 years, when you look at, the central banks and suppression that they've had on interest rates and on carry and on the bond market. And yes, you got the price appreciation, but the actual carry that you got in the bond market, was pretty low. And of course, that funneled money into risk assets. Now we're seeing a very different environment, and I think that bonds now play a very important role in a diversified portfolio.
Marilyn, just quickly, that word diversified, is that uncorrelated diversification? Because what we witnessed yesterday, we were told at the start of this year we'd get a break between equities and bonds, and that hasn't happened. Is that going to be uncorrelated diversification with treasuries?
Yeah, so I think it is important to focus on less correlations, and I think we will see correlations. We're still continuing to see this strange dynamic at the moment, and we've seen it again this week in terms of bonds and rates as well. But I do think as we move on in the business cycle, we will see less correlation, and it's incredibly important to focus on aspects of beta, to focus on correlations, and to really understand the drivers of the returns of a specific bond or specific equity. And I do think that's an incredibly important part of a portfolio now, yes.
Marilyn, this was great, as always. Don't be a stranger. It's good to catch up. Marilyn Watson there of BlackRock on this bond market. We're waiting for that break, aren't we, Bramo? Where is it?
Yeah, I mean, let's see. I don't know. I'm
Treasury's
curious.
Up, stocks up, Treasury's
down.
down.
Yeah, I don't know. I think
down.
that it's going to take perhaps a terminal rate that's established before we get that back.
And we're still trying to establish that, aren't we? Getting closer, I'm told. It's through 5 at least.
That correlation question, that was some real University of Warwick finance there.
Warwick, you got that.
Very Omega.
Nice, thanks for that.
Not Egg Omega, like Omega Omega. You nailed that.
Okay, appreciate that, Tom. Think futures have a third. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's release of Federal Reserve minutes are likely to show how much support there is for larger interest rate hikes. The question is whether more officials considered a 50 basis point hike at the last meeting. And the tone could hint at how policymakers are interpreting recent data on inflation. The European Union has slashed its natural gas demand this winter by almost a fifth. That beats a voluntary 15% goal that was aimed at helping it survive the winter with lower gas flows from Russia. Finland saw the biggest drop. Usage there was cut by more than half. In South Africa, the stricken power utility company Eskom will get $13.9 billion in debt relief from the government over the next 3 years. In return, Eskom must partially privatize the country's electricity transmission network and coal-fired plants. Now, it also must improve its performance. Since 2008, Eskom has imposed blackouts that have rocked South Africa's economy. Tesla is prioritizing battery cell production in the U.S. over its factory in Germany. The reason? President Biden's Inflation Reduction Act, which includes manufacturing tax breaks. The new law's incentives have fueled concerns that Europe will fall behind in the race to attract production of electric vehicle components. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
So you've been here for a while?
Yeah.
What we've seen in the most recent quarter is that we've actually had share gain from some of the lower and middle income buckets as well. And so as these consumers are being more discerning, as they're looking for value, and importantly, in a world where convenience really matters, our value proposition is resonating with them.
Lots of consumers trading down. That was John David Rainey there, the Walmart CFO and executive VP. Home Depot had a tough time yesterday. Not just Walmart. Yes. Home Depot down about 7%. They're forecasting a tougher earnings story, Tom, and ultimately higher labor costs as well.
12 seconds on this. What was the distinction between Walmart and Home Depot?
The labor story. I would say without a doubt, on top of the outlook for both weren't tremendous, but Lisa, ultimately the labor story. Well, we had a guest on yesterday, didn't we? Was it from UBS?
Which one?
Carrie Short.
Yeah, that's right.
Talked about the cost to serve was getting more expensive, bottom line.
And we heard that just from Stellantis, that basically this is the equation. How do you offset with cost cutting the increase that you're seeing in costs as well as the lack of ability to pass it along? Home Depot is uniquely problematic simply because they're catering to the housing market. And again, we've seen the pain there.
Wrong Swiss bank, Credit Suisse. There we go. Karen Short, Credit Suisse. I wouldn't say that, Tom. Not at the moment, anyway.
Getting myself into trouble.
But it was a good conversation yesterday.
It was.
On the retailers, yeah. You causing more trouble?
No, I'm just looking at equities lift off the carnage yesterday. And, you know, I guess it's a McKee kind of end of the week. There's a lot of economic data coming up. Maybe we'll get some guidance off of it. John, 3.93% on the 10-year yield.
I know.
You know, it's.
Well, go to 7s. I'll give you 4.
Yeah.
Go to 6 month. I'll give you 5.
What we're going to do now is we do.
Any takers.
Keep going. Keep going. Yeah, yeah. 3 months. 3 months. 6.
Sell cattle. Never get rid of me. I'd
love
that.
Sell cattle?
Just the cattle auction. You know.
Yeah, I think so. And then you could make, lemon gelato.
Awesome. Nailed it. That's great. That's my future. Thanks.
Saving us right now is Anisha Sherman, Senior Analyst, U.S. Apparel and Specialty Retail at Bernstein. And what's so important here is there's always a tendency to focus on fancy luxury. And Anisha Sherman has just first-order condition abilities in what real retail's doing from sea to shining sea. She's got real work in retail and, of course, her excellence in securities analysis as well. Did they move inventories, Anisha, off of the gloom of 90 days ago? Did TJ Maxx and the rest of that world, did they move the stuff out the door?
Yes, they have. And TJX outperformed on comp for the Marmaxx chain, which is Marshalls and TJ Maxx. That's the core 2 banners. Their comp was fantastic. It was a +7 versus expectations of kind of a +3 to 4. And so the performance on the comp, on the traffic, on inventory moving was strong. Margins were a little disappointing, but the sales came in.
What is the path forward? If we're in a new rate regime where all of a sudden money costs something and they have a carry on all of their retail, what does your world look like forward? Is it a block and tackle quarter-to-quarter move, or can there be some real vision?
No, I think for the lower end retail, for the value retail that really got killed last year, they're looking at a really strong 2023 recovery because their comps last year were so weak. The lower income consumer was more pressured last year. Fuel costs have come down sequentially, though inflation hasn't. And so they should be expecting stronger performance in the coming year than they did a year ago. Now, that's very different from some of the more premium brands that did fantastically last year and are now facing the tough comparables.
Is this just a comparison type of story, or is this something deeper that has to do with the fact that people are trading down? People are looking to cut costs in their own lives and might be looking at a discounter rather than a Nordstrom's.
Yes, we've heard that narrative from companies for the last several months now. People are more cautious. They're more likely to buy on deal, less likely to buy full price. Kind of considering the weight of the purchase a little bit more than they were, say, a year ago when they were happy to spend and happy to pay full price and getting out of the COVID mindset. So there is a lot more caution in the market. I think that will benefit TJX and its peers, Ross and Burlington, which report next week. So I don't think it's just about anniversarying soft comps. I think it's also a sequential improvement in demand.
How big will that divergence become, particularly in the share price as well as the earnings as the year goes on? Because I'm looking right now, TJ Maxx down just a touch on the year so far, not including today's pop. And then you look at Nordstrom, and it's up more than 20% on the year. Will that reverse? Will you see the reverse kind of correlation?
I don't know if we'll see off-pricers derate because they didn't do as well last year. TJX was an exception. TJX was up 6% last year, beat the market, beat the sector. So it's fairly well valued at the moment. I think we'll see continued upward momentum on Ross and Burlington that still ended last year down, and so are recovering from that.
Anisha, we've been joking about how we could have just had a meteorologist on pretty much for every segment at the end of last year, and it could have probably given us better landscape for what we were to expect this year. How much does weather feature into this? And I want to say not with people going to stores, but with respect to the gasoline price and the price of utilities going down, giving people more discretionary spending.
Yeah, I think it is a big part of it. I think especially for these lower income focused retailers, the value retailers, any relief to the lower income consumer, whether it's easier fuel prices or fewer trips or lower inflation or lower sequential inflation, any relief goes straight to the bottom line in terms of spend because they really have come under pressure, these consumers. And so any relief helps them spend a little bit more. So anything weather related that will drive a little bit of relief on gas prices would certainly help.
Somewhere there's the middle, Anish, the distance from Dior to TJX. There's got to be a middle ground. I haven't understood for 20 years what the middle ground of retail does. After the pandemic, maybe we're overstored. There's some mall issues as well. What do all the players in the middle do?
I think the middle is in a really tough situation right now. That is the kind of middle end or slightly lower end department stores, some of the mainline retailers that are kind of mainstream retailers. I think they're in a tough spot because they are going to see some trade down going to value, but they are not immune to consumer pressure the way the high luxury brands are, which are continuing to perform. So I think they are going to get squeezed. We're going to see more store closures and more perhaps more bankruptcies through the next 12 months or so.
Anisha, we had this explosion of buy now, pay later. One of those brands were, I believe, Affirm, and I think Affirm came out with some big job cuts in the last couple of weeks. Anisha, that helped a lot of people fund some big purchases to make them just say a monthly payment. Anisha, have you seen any of that start to tail off, start to fade, and what does that mean for the bottom line of some of these big players?
Yeah, we have. We have seen, Macy's has said, for example, for their own credit cards, payments are down, carrying balances are higher month to month. So I think the demand for something like buy now, pay later is probably still there, but the supply is probably coming down because of rates. So I think we will see that, and that's probably part of what we're seeing in terms of the consumer caution is there's less easy access to financing and funding.
Interesting. Anisha, thanks for that. Appreciate it. Great to catch up with you, Anisha Sherman of Bernstein. That last point is a really important one, Tom. All those lines that you see at luxury stores, a lot of people going in there. It's buy now, pay later online.
Oh, yeah.
You can buy a really expensive item, just make it a monthly payment.
No question.
All of a sudden, something that's just totally unaffordable,
Yeah.
thousands of dollars, is just like, $100 a month.
And you're seeing credit card receivables go up, and you're starting to latency rates slowly tick up. But you're right. How much do we see that buy now, pay later disappear?
And I look at Kohl's, which KSS, which is, what Anish was talking about there. Or even if you go upscale to Nordstrom's. I mean, Nordstrom's 10-year track record is a negative 6.9% per year. Why are you in business? I don't get it. I just don't, I get it. It's a family. That's the answer. But the whole middle ground of retail, it's a mystery.
It's been tough for how long now?
20 years.
A long time.
Yeah. I just.
The thing I've never understood, and just to sort of make a bit of a transition, when you go up, say Lexington Avenue in New York, or for that matter, Madison. Pick an avenue at the moment.
I've never been on Madison.
All the empty storefronts. Yeah. Still, at least I ask the same question. I ask this all the time whenever I walk down them. How? At some point, don't you have to cut the price to the rent to try and get someone in there? And I'm told that there's a lot of people invested in this real estate. They're looking for write-offs.
Exactly.
I just don't get it.
That's a great question. I've talked to people about it. Basically, you can do a tax deduction based on lost revenue if you don't rent it out. If you rent it out, you've got to lock in a rate that is subpar, and then you have to next year lock that into your
years
interest
of this
rate expectation.
Now.
Exactly, but
They're
this
just going to do this indefinitely.
At what point does this become a political issue to say you have to change the scenario to revive an area that's been kind of decimated? You look around, you look at entire areas in Midtown that have no activity in terms of storefronts that are open.
Major shout out to Cranes, which is specialty, is talking about real estate in the island of Manhattan and other cities as well. And what you're talking about, John, is the Cranes unspoken. Nobody really wants to talk about empty storefronts. They'll talk about the 15th floor, the 50th floor, but they don't want to talk about the first floor.
You came back after the long weekend and you said to me, Midtown retail.
It's changed. It's just gone. It's just, the spirit is different.
Equity futures right now, up 0.25%. Michael O'Rourke of Jones Trading. Coming up next.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We are now expecting inflation to overall continue to decrease throughout this year, despite the fact that the last reading have been a little stronger than expected.
The consumer is extremely strong. Companies' balance sheets are extremely strong.
U.S. consumers are not really being hurt by high rates.
There's going to be a pause. I mean, you cannot annualize the degree of performance we've had this year.
It's possible that we'll go into a recession, but I would say the recession will most likely be mild.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you so much for being with us on a Wednesday, on radio, on television, in the markets. It is a bond move and also the diplomacy of Europe. And John, I want to link this into the financial world now. Read the Munich Re website. We have Putin and Wang talking in Moscow. We have Biden talking with Budapest 9. And the Munich Re insurance company announces with profitability a €1 billion buyback. And read their website about Eastern Europe and continental Europe during the time of the Nazis. It is a history organization on what Munich Re did different than all the other German companies, and it speaks to the tension that we face in 2023.
Well, let's speak to the moment of this week.
Yeah.
In terms of geopolitics and what we've seen from President Biden going into Ukraine to kick off the week on President's Day.
Right.
Talking about solidarity with the Ukrainian people, worried, almost nervous about whether China gets involved directly in this war by funding and providing direct assistance to Russia. And then this headline crossing earlier on this morning, Wang Yi, China's top diplomat, saying the relations with China and Russia are solid as a rock. Tom, I think that speaks to the tension between the United States and China more than anything else this morning.
And underreported, because it's in Russian, was Putin's speech, which I heard from Robert Service and other true Russian experts, was the most chilling speech they've heard back to Stalin. And to link this again into the finance of Munich Re and the recovery of Germany, I mean, they came out after the war and were relatively the first to make reparations to Jewish people that lost property in Germany. I mean, the tension here, as you mentioned with your Shoals question 2 hours ago, where are Shoals? There are delicacies in this delicate time.
Look, I think we are still in a world, Tom, where it's an incredibly low probability event that we end up in a proxy war between the US and China.
Yes.
But it's still got a probability assigned to it that isn't zero, and we need to discuss it. And if that takes place, I just wonder where that leaves Chancellor Scholz of Germany and what his position is going to be on it all.
And you fold this in, Lisa, to the tensions in the bond market. You know, are we all in agreement the last 90 days have been absolutely nuts in the financial markets? I think that's true.
In the bond market specifically,
and to me, it's all linked into this war anniversary, to a Europe in recovery, and obviously bringing it back to Munich Re and the rest, people just trying to survive through this.
It's the mystery of pandemic economics mixed with the exogenous risk of an ongoing war and the potential for escalation. And what that means is people believed in immaculate disinflation until they didn't. You saw a terminal rate priced in at 4.8% until it went to 5.3%.
Where is it now?
5.4% almost at one point. It's been whipping around. I mean, now it's back down to 5.3. But people are gaming out a scenario where suddenly the strength from a warmer than expected winter enters the sphere of this muddle that we have with pandemic economics and then the geopolitics, which really does raise a sort of existential issue going forward.
John, the 10-year yield near 4%, you do better on this than I do. Is there anyone modeling price down, yield up through what we saw in October of last year?
Well, we're going there now.
We're getting there
the last
quickly.
24 hours. Intraday, we've not got there yet. So intraday, I think it was early November on payrolls Friday, where we got to close to 480 on a 2-year yield. We came just short of that in yesterday's session, but on a closing basis, the highest level since 07 on a 2-year, and right the way across the curve, 2s out to 30s. Whole curve just shifted higher by more than 10 basis points, Tom, in yesterday's session. Bond market looks like this morning. We come in about 2 basis points on a 10-year, just a little bit. But TK, we're still close, aren't we, to 4%, 392, 73.
Yesterday was something, and John, we've moved away from that accommodation Bloomberg Financial Conditions Index. Positive 0.14 is a long way from that positive 0.50 effort we tried to get to.
Worst day of the year in the equity market yesterday on the S&P. Futures positive 0.2%. Fed minutes out at 2 p.m. Eastern time. We're going to hear from New York Fed President John Williams a little bit later as well. Was that 5:30?
Yeah, 5:30 p.m.
A little bit later this afternoon. I've said all morning, I think those minutes from the Federal Reserve are pretty stale, given what we've had on the data front between the last meeting and now. I got this message from Stuart Hampton on Twitter just moments ago. They're not stale if they're hawkish, is what he said. And, I think that's the bias at the moment, is it? If it's dovish, it's like, yeah, but they didn't have all this data, it's hawkish. Wow, they must be really hawkish.
People are looking for some sense of whether they're upping their terminal rate. Will the Fed massage the minutes? You're laughing about that, but there is this idea that they can push them in a certain direction, and that will perhaps feed into the hawkish bent that people are looking for. Tom?
I'm just looking at what I really can't say enough as we go into this hour with Ed Hyman and Michael O'Rourke here in moments, John. The stew here, and yet there's a venerable company, Munich Re, just saying, forget about it. We're going to buy back shares.
In tons of buybacks, Tom.
Yeah.
Loads of that. But the labour pressure, don't forget the labour pressure. I think the labour pressure in the last 24 hours in retail is something we really need to keep an eye on. It wasn't a massive story a year or so ago because they could pass it on. They could pass it on in pricing power. We didn't really witness that in these releases yesterday.
Let's dive into it now with futures up 8. The VIX out to 23.14 on the VIX. Michael O'Rourke joins us, Chief Market Strategist at Jones Trading. Michael, to the broader theme there of a German reinsurer with a huge buyback, and yet all the tangible gloom out there, is the O'Rourke glass half full or half empty?
Oh, I'm definitely in the half-empty camp here. I think we've had an incredible corrective rally in a bear market over the past 4 months, and I think we're probably ready to resume that downtrend that's probably going to last most of the year.
So how do you push back against people who say, we've seen a real strengthening in the economy, we've seen both growth increased in terms of the expectation, but also Fed rate hikes? Why don't you just basically lean into that, given that a lot of companies are doing, to quote Tom, better than good?
Well, I wouldn't even say they're doing better than good, because when you think about the situation we're in, we do have economic strength. We had economic strength in January, and the preliminary PMIs reported yesterday look like it's carrying over to February. And we still see, basically hot economic data, still high inflation levels. But on the flip side, you have Home Depot and Walmart yesterday say earnings going to be down year over year this year. So you're looking at an environment where the Fed does need to be tighter. We only just moved to a positive real Fed funds rate earlier this month, and we still have an inflation problem. So you're looking at a policy outlook that's just going to be very unfriendly going forward. And again, the fundamentals for companies are, they're slowly deteriorating, I guess is the best way to describe it, but they're not improving.
What will it take for big tech to underperform again, given the incredible outperformance earlier this year?
Oh, I think we're probably going to enter that phase here. We have interest rates rising again. People realizing that, inflation is not under control. I think you touched it in your the conversation you just had about what's going on in Europe and between the China and the U.S. Yeah, there may not be a proxy war, but we are seeing deglobalization themes. And I'm still a big believer that China entering the WTO in 2001, created that stable, low inflation environment of the past 2 decades. And we're not going to have that going forward. So it's going to be a much more challenging environment. For the past 15 years, we've had a negative real Fed funds rate on average of over 1.25%. That's not going to be the case going forward, and that's going to be harder for investors.
Does that get you to a blended single-digit return? And can I say with more pension-like money, do you actually have to reduce your actuarial assumption?
I would say I think you do. I think we've had this just beneficent environment for the past 15 to basically post-global financial crisis. The Fed had this latitude of continuing to be able to ease and pump liquidity into the market anytime any sign of weakness. We don't have they don't have that flexibility anymore to react like that. They have to be concerned that if they're at all accommodative or even showing less vigilance on inflation, that you're going to see inflation expectations uptick. We still have a high inflation environment. It's something they definitely have to get under control. And we're still just not there yet.
If you had to take a guess, let's say we're at 470 right now on a 2-year. Do you think it's more likely we get to 530 first, or is it more likely we get to something like 420?
Well, it's funny, we were just at 420, right? So it's interesting. If you look at the 3-month annualized rate of inflation, the core CPI, over the past 3 months, it averaged between 4 and 5%. If you go back over the past 40 years, every time we've had inflation at those levels, I'm not talking about the high inflation levels of the 70s, I'm talking between 4 and 5%. You've seen interest rates, 250 to 300 basis points higher than where they are today. And I think that's one of the reasons inflation is still going to be sticky until we get rates a bit higher here. You're looking at an environment where you'd have a real Fed funds rate of 300 basis points as opposed to 22, 23 basis points that we have today.
Yeah.
So from that type of environment going forward, I think you're going to see rates go higher.
Okay. Was that basically a call to say the next 50 basis points is higher than not lower, Mike?
I would say so, yes.
Wow. That's a call. So for the next 10% of the equity market, you'd say 10% lower, right? Not 10% higher.
Lower. Absolutely.
Michael O'Rourke there of Jones Traded. Thank you, sir. Just trying to work out the balance of risk for a lot of people, where they think the next big moves come from.
Heads are spinning. The balance of risk
after the data we saw, without a doubt.
Your heads are spinning. I mean, we've been busting Brahma's chops all morning about conundrum and enigma, but she's absolutely dead on.
Conundrum wrapped in an enigma.
Well, yeah,
I like
it's
that.
Poetic, but it's also true.
Now that's going to be in a promo now for the rest of the year.
Conundrum wrapped in an enigma.
That's great.
Watch
With
Bloomberg
that
surveillance.
Voice. That's awesome.
Yeah.
Love that.
That's absolutely terrible. Yeah. I do think, though, that this is going to be, in terms of the next big move, a lot of it's going to be also tied to big tech. And that, to me, is sort of this interesting outperformance. I just, how much have people really gotten out of that position?
Can you imagine 520, 50 basis points higher on a 2-year? Just 520 on a 2-year.
I think there's a lot of the public that, John, they can't imagine. Imagine it. We've been there.
Amazing.
Yeah,
Futures right now positive a tenth, 0.2% higher on the S&P 500, 8:30 Eastern time. Don't miss this. I might, but that's because I've got to be somewhere else. But don't miss this. Ed Hyman
That's
of
also going to be the promo.
Coming up in 18 minutes. I mean, I felt bad teasing it, but, you know, don't miss this.
Sold that,
It
John.
won't be it. Don't miss this. Ed Hyman's coming up. Looking forward to hearing that conversation.
Keeping you up to date with the news from around the world with the First Word, I'm Lisa Mateo. We may get a sense of how many Fed policymakers saw the case for a larger interest rate increase at their last meeting. The central bank will publish minutes of that gathering at 2 p.m. New York time. They may also show whether Fed officials anticipated the need to take rates higher than previously thought to tame inflation. In Poland, President Biden is meeting with Eastern European leaders who have supported Ukraine. Those countries have sent weapons to Ukrainians and taken in millions of refugees who were fleeing Russia's war. President Biden returns to Washington today. China's top diplomat calls relations with Russia solid as a rock. The remarks by Wang Yi come as Beijing is trying to portray itself as a neutral actor that can broker peace in Ukraine. Wang met with Vladimir Putin in Moscow. Meanwhile, the Wall Street Journal says China's President Xi Jinping is preparing to visit the Russian capital. The biggest maker of computer processors, Intel, is slashing its dividend payment by 66%. The company wants to preserve cash for investment. Now, in its earnings report last month, Intel forecast one of the worst quarters in its history. Chip companies have been hammered by a steep drop in demand for personal computer processors. And the Biden administration will cut mortgage insurance costs for some first-time home buyers. The program will be unveiled today. Borrowers with mortgages insured by the Federal Housing Administration will see their fees cut by about $800 a year, or 0.3 percentage point. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. This week, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage starts February 23rd. Bloomberg, your global business authority.
I regret today's decision by Russia to suspend its participation in the New START treaty.
President Putin is in no way preparing for peace. He's preparing for more war. He's preparing for new offensives, and he is mobilizing more troops and sending in more weapons. And that's exactly why we need to step up our support for Ukraine.
Jens Stoltenberg, the NATO Secretary General there, addressing the world. Russia firing back in more ways than one, Tom, in the last couple of days. Some pretty fiery language from Vladimir Putin, a Russian leader, getting an endorsement from China, calling the relationship with Russia rock solid this morning. Tom, that's quite a striking headline, given what we've seen over the last couple of days.
And the video images, which we haven't shown yet, are really something. I mean, this is a typical Kremlin-like white room, white table, except Putin's not sitting at one time zone and the other guy's sitting at the other time zone. It's, images matter. They're right across the table from each other, being fraternal.
Tough to confront the counterfactual, Tom, but I do wonder whether we would have heard that headline this morning from China's top diplomat if we hadn't had the issues we have had over the last couple of weeks between China and the United States and that alleged spy balloon that traversed this country. Would we have heard that language from China's top diplomat this morning saying that?
Basically, is this way for tit for tat, right? Basically ratcheting up some of the tensions and saying, we want to get involved and show our strength and your potential weakness in this type of situation, that if you aren't going to play ball with us, that we're going to ratchet up tensions on this side. How much is it sort of a negotiating tool from China?
The relationship is solid as a rock, Tom, and will stand the trials of the changing international situation. I think there was another headline earlier this morning that said we won't be influenced, pressured by a third party, and I think we all know who that third party is when they say that.
And again, traveling back to Washington will be President Biden. Traveling back through London will be Anne-Marie Horton, our chief Washington correspondent. For America, we're going to take advantage of Ms. Horton's commitment to really learning and understanding the history of the continent all the way out to Siberia, which she's done for years with Bloomberg. Anne-Marie Horton, I want to talk about the elephant that's not in the room, and that is, we talk about the Budapest Nine, except the guy from Budapest isn't there. I don't know if it's Bucharest, Budapest.
Nine.
It's Bucharest. Let's talk about the Budapest Nine. And the answer is the guy from Budapest, Orban, is not there. This is really important when you look at the Budapest Nine.
This is important. I mean, Viktor Orban has been a rebel, some would obviously say, someone who's dragged their feet when it comes to sanctions. Just this week, he's talking about the fact that he wants to maintain these economic ties and strong relationship with Moscow. He also is talking about the European Union, saying that when Russia invaded Ukraine, it was the West that has elevated this into a bigger conflict. And he views it, this is Viktor Orban's words, as two Slavic nations fighting against each other. This is something you don't hear from many European leaders, and he is obviously absent today, the elephant not in the room, as you correctly noted, Tom. He will be sending another delegation, but the FT talked about this as well. There's this Orbanization of the Hungarian military-industrial complex, and it's very difficult at a time when you have the Biden administration, alongside President Duda and other Western allies, meeting with the Bucharest Nine, wanting to talk about a closer relation of these countries within NATO, and you have Viktor Orban kind of, poking holes in these alliances.
Help our American listeners and viewers, Anne-Marie, how unified is the Bucharest Nine? I mean, you think about the bridge in Prague that's so historic to everything in, medieval times and all that. Forget about all the history lesson. How unified are these nine?
Well, I think it's pretty clear that these nine are pretty unified in the sense that the day after Putin invaded Ukraine, these nine quickly wanted to coalesce and have a meeting, because obviously their concerns, being either part of the former part of the Soviet Union or were part of the now dissolved Warsaw Pact, they wanted to make sure that, one, this did not go outside Ukraine borders and that they were not next in terms of anything President Putin was thinking in terms of more than aventurism, but absolute invasion of these former Soviet countries. The group was also created after Putin annexed Crimea. It was created in 2015. He annexed Crimea in 2015. Obviously, we saw the fighting in eastern Ukraine since then. So there has been this concern and the growing collective concern amongst this group. So I would say they are pretty united in those concerns, but obviously you have a spectrum of the President Duda likes and those like Viktor Orban, who's once again really saying that he thinks that these security concerns are overblown.
I believe that President Biden heads back to Washington, D.C. either later today or early tomorrow. And this comes at a time when he just expressed solidarity with not only the Bucharest Nine, but also all of Europe, and saying that they're going to counter Russia. Have there been any tangible takeaways from this other than the ratcheting up in tensions between China and Russia on one side and the U.S. and Europe on the other?
Well, I think one of the main things to watch out for when the president heads back to Washington, D.C. is something he's flagged and we've even reported on, is that there's going to be another tranche of sanctions against Russia. It's going to be penalties against key industries, potentially more export controls, as well as going after more individuals. So that's one tangible thing we can take away from this trip, as well as more aid to Ukraine. But overall, this trip was really about symbolism. As they have this wariness and fatigue rising amongst countries around the world about the fact that everyone is starting to settle in and realizing this is not a quick conflict. This is going to go on for a long time. President Biden wanted to make clear that the U.S. will remain united with Western allies in providing that funding to Ukraine, but also making sure that they further try to isolate Russia, which is why the split screen is fascinating, because Russia is trying so hard to show they are not isolated, because look who's in town, and it's China's top diplomat.
Okay, is it Russia or is it China? And this goes to the question, what message is China trying to say at a time when Xi Jinping is trying to say that they want to facilitate some peace talks, and yet they're talking about their unwavering support of Russia?
China is playing a two-part game at the moment. Publicly, they obviously are trying to do this quote-unquote peace plans, which is very much so being questioned with a lot of skepticism when you talk to European or U.S. officials. But this is something that the global South, countries in Latin America, countries in Africa, would likely welcome, countries that are struggling with food insecurity and energy insecurity. So this is something the U.S. also needs to make sure globally they try to build up some support to counter that. At the same time, Xi Jinping is trying to be seen as a global statesman, someone that can try to play this hand of bringing peace. But behind scenes, what is going on is that Xi Jinping has had no problem calling President Putin on the phone a number of times over the course of the past 12 months, but has yet to call President Zelensky. And obviously, the United States has made it pretty clear that they're concerned about Beijing going over a line of not just sending any help to Russia, but lethal help to Russia as they continue to advance this war in Ukraine.
MH, this was great. I'll catch up with you in the next hour on all of this. Anne-Marie over in Poland today. She'll be in Europe through the rest of this week. Coming up in the next hour, here's a lineup for you in the Open on Bloomberg TV, going into the opening bell. Jay Pawlowski's coming up of TPW, alongside Daryl Cronk of Wells Fargo. Laurie Calvasina of RBC Capital Markets around the opening bell at 9:30 Eastern Time. But Jay Pawlowski, very, very constructive on the global equity story. Daryl Cronk, much more so on US equities, Tom. So that's going to be the US versus Europe conversation a little bit later in the next hour.
Yeah, but I think Mr. Pawlowski's also said he was way out front of the medical salvation of China, the China Open, the Pacific Rim Open. And the last time Daryl was sitting right next to us here, I mean, he was great. Extremely constructive, like we're going to hear from Ed Hyman here in 5 minutes, on the American experiment. It can survive given high yields. All these guys are older. You know, we've lived this.
They've seen it.
You know, but I mean, Ed Hyman loved Bob Seger. He told me that, you know, he was completely all over Bob Seger.
On a serious note, Ed Hyman on China and Evercore on China GDP. That's the call I want to hear.
Yeah.
They got a big call on that.
Big call. They're optimistic on it. I think they peeled it back a little bit, but yeah, optimism.
And looking forward to that conversation coming up in about 5 minutes' time.
It's wrapped in an enigma.
It is. Who said that?
I don't know.
Who said that?
It's poetry.
A wise woman once said. About 2 hours ago.
No one remembers her.
Future's positive. This is Bloomberg.
many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where is it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David. But COVID, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, COVID's enough of a change that I ought to be able to do something new.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, Lisa Bramlett and Tom King. We welcome all of you around the world, across this nation, on radio, on television. It's been an extraordinary day for us. We've been busting Bramwell's chops about conundrum and enigma, but that's what we're hearing guest to guest. I mean, that's the reality.
Everyone comes out and says this is the most uncertain time in our entire careers, because how do you game out the pandemic era, plus what we saw with Russia's invasion of Ukraine, plus what we see with respect to some of the stimulus that we saw globally? Put that together, and there you go.
I'm going to really put it off the once-in-a-lifetime pandemic crisis that we've had, and what we know is it can only be smart conversation. Edward Denny with us earlier with a perspective that's been dead on and no landing, and leading that charge and hugely anticipated for this entire half hour. Edward Hyman joins us today. He is vice chairman at Evercore ISI. We're thrilled that he will have an extended conversation with us. And yes, we'll get to the China call here in a bit. Ed Hyman, thank you so much for your generous time this morning. You say inflation is slowing significantly. David Rosenberg, you knew him at Merrill Lynch, says inflation is slowing significantly. It's on the good side. Do you see service sector inflation slowing?
Yes, I do. So there's Tom, it's great to be on your program. It's a terrific program, Lisa and John. As I tell you guys, it's just wonderful. But there's a PMI for services, and it's dropped 20 points from 75 to 55. And there are plenty of services that I think are slowing, particularly in the financial services area, insurance, et cetera. But that's the key, is to get the measure that Powell watches to slow down. One of the big services is rents. And I'm convinced they're going to slow dramatically and maybe even go negative for the shelter CPI. There are half a dozen measures of rents. Surveys of rents, and they've all slowed significantly, if not declined, over the past 9 months. And they lead the shelter CPI by about 8 months. So I'm a couple of months late now on this showing up. But I think the shelter is going to slow. Mm-hmm. And then before you ask it, wages are going to slow. If McKinsey is laying off people, what can you say?
Well, can we make news here today? Is Evercore ISI laying off people? I mean,
they may lay off me if inflation doesn't slow.
We've heard this in C.J. Lawrence. And Julian Emmanuel, be very careful here with the tough guy, Ed Hyman. Ed, I want to cut to the chase, which is the heritage of what you've done since C.J. Lawrence. I mean, it goes back to Wayne Angel. It's about monitoring M2. As you know, M2 is in disrepute, let's say, over the last decade. Why are you following M2 and its collapse so carefully in your research note?
So I met Milton Friedman when I was 23 years old. And in the 70s, he became a rock star. And every time you had a bout of inflation, money growth accelerated 10, 15%. And so it was an easy connection in that regard. Then getting to today, bank deposits, which are 85% of the money supply, are a practical way to track it every week. And they have declined significantly. They're down about 2% now, and they've declined 100 billion in the past 2 weeks. This is going back to the 1930s to have a situation like this. Now, we found over a decade that the money supply might not have much of an impact if it's in a normal range, say 5 to 10%. I think Margaret Thatcher found that out when she was trying to gear monetary policy with Friedman off of swings in the money supply. But last year, the money supply increased almost 30%. The year before that, government outlays increased 50%, and the Fed monetized it. And now, M2 last week was minus 3%, which is a ominous or significant decline. And it leads by 1 and 2 years. So it you can't see it on the program you have this morning, but it's coming. And I think it shows up in some of the slowdown of inflation readings we're seeing now, like container freight rates, natural gas.
This really speaks to the long and variable lags, Ed. This discussion around the tightening and the removal of accommodation and how long it's going to take before we start seeing it in the data. And as you say, you and many others have been surprised that we are not seeing it more and that you're even seeing a reacceleration in certain inflationary reads in specific segments of the economy. What does long and variable lags look like in 2023 in an era of so many cross currents of different trends?
1 and 2 years.
That's it.
That was the standard. We do a lot of standard for Milton Friedman. We've done a lot of econometric work on global short rates. They lead by 1 and 2 years. And if you'll hang on for a second, in 1923, John Maynard Keynes wrote a paper that said the money supply leads by 16 months. I've not been I've been surprised, but I haven't been fighting the idea the economy is strong now, because a year ago, Fed funds were zero. QE was in place, and the money supply was around 10%.
Yeah.
Those, those are all now totally different. And so that will show up more toward the end of this year and on into 2024, I think.
Until we see the long and variable lags actually play out, people are talking about a no-landing scenario, that we possibly could avoid any kind of recession or downturn or even a significant slowdown and end up reaccelerating into a new bull market. Do you push back against that and say, look, in a year, 2 years, we're going to see some sort of downturn, and the longer that you have faith in this no-landing scenario, the more potentially fraught it could be?
On the no-landing part, I mentioned long and variable lags, and they're pretty painful. Reinhard Rogoff wrote a piece in early 2009 criticizing people that had moved to the view that we would have no recession, that housing weakness would be contained. And it's different this time, became very popular. And that's what's going to happen, that's what's happening now, and will continue to happen. But I think, judging by it will end up creating a recession toward the end of this year or into 2024. But it's going to be pretty painful. And the no landing story, I think, is looking at things right now. And right now, the economy is doing great.
Well, with Ed Hyman, folks, and we welcome all of you on radio and television, generous to be with us for this half hour. I do want to point out that there's a full econometric display in his research note, including an R-squared of 68% on what short rates are going to doing. But to get out front, folks, we protect the copyright of all of our guests. Go to Evercore ISI to get the Ed Hyman, Dick Rippey, and the rest of them religion, if you will. Ed Hyman, I want you to speak to those younger. They didn't read you at CJ Lawrence. They barely know your research note at Evercore ISI. They've never faced this rate structure, this return to a real rate. there's a whole feeling life can't go on. Explain how life goes on if we come back to a legitimate interest rate regime.
It seems to me, Tom, that we're already getting into an environment where life goes on because the economy is doing so well right now. I know there are lags involved, but the stock market, is pretty contemporaneous, and they know that rates are high. And so I think we're getting there, but it's a learning process. The Fed, I think, is doing a pretty good job of communicating what their plans are. If I was them, I would pause and see what they've gotten done so far.
Right.
And then it turns out they need to keep going. They can. If it turns out they should continue to pause or cut rates, they can do that. But I would pause right now, given how much water's under the bridge.
Ed Hyman, as we speak to you, it is images of the President of the United States meeting with the Bucharest Nine. Of course, this historic moment for Eastern Europe after the President's trip to Ukraine. Ed Hyman, I say this with immense respect, and you remember the politics that we've all faced. How do you overlay the politics of the nation into what has been a multiple decade Hyman optimism? How do you take the challenges of the time of Jimmy Carter, fold them over to the time of Joe Biden, and overlay them on a belief in the American economy?
That's too much for this morning. But I have a deep respect for democracy, and I'm a conservative. But I see a benefit in the back and forth that we have going on right now. I think it's too extreme, but it plays a role in our system. And so at the moment, I don't see it being a terrible impediment. Powell is doing what he's doing. I don't know if you have seen it, but federal outlays are scheduled to decline about 5% this year in 2023. Now that they went up 50% in 2020. So let's not celebrate too much. But it is a crazy world. The parts that I find most troubling, and I'm sure you do too, is the war situation and also the situation in China, which I'm constructive on, but they definitely, they have a more problematic situation politically than we do.
And I'm sure you were briefed on our script and that we're going to come back and talk about China, the optimism that Edward Hyman and Evercore ISI has on the global economy, and a stunning expectation of China recovery. Ed Hyman will continue with us on Bloomberg Surveillance. Lisa, I get almost goosebumps here about the moment that we're in, where we all have this, we've been busting your chops, but this conundrum and enigma and the sum of all our fears. And in the real world, you read the people that you choose to read, and that's what Ed Hyman has brought over the many years.
And the conundrum wrapped in enigma is a butchered rendition of Winston Churchill back in 1939 when he was speaking in an address.
Are there elements of 39 right now?
Well, that's the question, right? We're looking at a moment of potential pivotal changes, and hopefully it's not quite the same kinds as 1939.
We're going to continue with Ed Hyman. Our Anne-Marie Horton is with the president in Warsaw. Stay with Bloomberg through the day. Good morning.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Today's release of Federal Reserve minutes are likely to show how much support there is for larger interest rate hikes. The question is whether more officials considered a 50 basis point hike at the last meeting. And the tone could hint at how policymakers are interpreting recent data on inflation. The European Union has slashed its natural gas demand this winter by almost a fifth. And that beats a voluntary 15% goal that was aimed at helping it survive the winter with lower gas flows from Russia. Finland saw the biggest drop. Usage there was cut by more than half. Tesla is prioritizing battery cell production in the U.S. over its factory in Germany. The reason? President Biden's Inflation Reduction Act, which includes manufacturing tax breaks. The new law's incentives have fueled concerns that Europe will fall behind in the race to attack production of electric vehicle components. In China, authorities have urged state-owned companies to phase out using the 4 biggest international accounting firms. That's a sign there's still concern about data security. The firms include PricewaterhouseCoopers, Ernst & Young, KPMG, and Deloitte & Touche. And how would you like a touch of olive oil added to your cup of coffee? Well, it's happening at Starbucks shops across Italy as the coffee maker struggles to gain traction in the country. The company plans to launch the new Oleato coffee line in the U.S., Japan, Middle East, and the U.K. later this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
To the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
If you take all of the regions globally, we've got the highest return forecast in Asia. It's partly a valuation story and a recovery, the opening up of China. And secondly, I think you really need to look within and beneath the equity index level to really find better relative opportunity.
Peter Oppenheimer is Chief Global Equity Strategist at Goldman Sachs. Can we suggest, Lisa, that Faro steals Oppenheimer more often than we get to actually talk to him? Or is it London just saying they have him first?
I'll go back and check. I'm always interested to hear what he has to say. Yes. We get him plenty.
We get him plenty. Peter Oppenheimer, they're very, very competent for Goldman Sachs. And of course, we say good morning to Abby Joseph Cohen, now up at Columbia University. I should point out is, well, what a joy to continue with Ed Hyman. He's vice chairman at Evercore ISI. And Ed, you stopped traffic here the last time you were on with an optimism on the China reopening. I believe you'd have adjusted real GDP. Where's your number right now on a China reopening? Is it still near 6%?
We have 6 at the end of the year. It's a complicated situation, actually a little more complicated than I expected, but we still think it's going to be very strong. They're opening up, and I've learned either the hard way or the easy way that makes a very big difference. When we had the pandemic collapse, and China did, I learned from China because their GDP was minus 50. And so I was estimating minus 50 for the U.S., which wasn't too far off. And then we had a big rebound, and GDP was something like 30. And that same in China and in the U.S. And so they have that dynamic coming on now as they reopen. and it seems to be pretty successful. They've gotten through the pandemic, and a very big percentage of people have had the virus, and so that they have a herd immunity going on, plus stimulus working through the system.
Well, Ed, how much will that actually trickle into the rest of the global economy, given the increasing isolation of China, both deliberately for a more focus on nationalism versus also an isolation with respect to the fissures that we hear right now with China in Russia?
Lisa, I think they'll export. Once they get the factories going, I think they'll be an increased source of exports. Just recently, they became the biggest exporter of vehicles. And so I think they'll do that. I think they're going to push up commodity prices like copper, but then come in and push down finished goods prices. I will say that I'm watching most closely the price of oil. And that is my North Star as to how China is progressing right now. And oil prices, which I look at on Bloomberg, frankly, all the time, they're pretty quiet right now, around $75 for West Texas. And so that tells me that China hasn't gotten ripping ahead yet. So I think that's coming. I think oil prices will go up.
This is incredibly important because a lot of people have come on this program, Ed, and said that the oil is incredibly muddied in terms of the price signal, given the fact that people are changing to renewables, given the fact that China has increased domestic production of wind, of solar, of even using coal or importing some of the materials from Australia. Are you saying that that's not true, that oil is the cleanest read of what's happening with China?
I think that's a fair point. I think it's an excellent point. And on the price of oil, just to pick one commodity price, if things like what you're mentioning are true for a number of commodity prices, it could feed into my strong view that inflation is going to be less than what people expect. Not to mention the fact that the money supply is contracting. But I think some of these technological advances that you mentioned could, put downward pressure on some commodities. Now, a commodity like copper is right in the middle of the technology advances. You need the copper wires to make the technologies work. But some other commodities, I've been watching natural gas, and you can see it making new lows both in Europe and in the U.S. Mm-hmm. And you can see when that happens, it really helps economic activity on a current basis, right? Particularly in Europe. But I think it's also working a little bit here.
I mean, Ed, I understand that, once a week, maybe once a quarter, you read Julian Emmanuel's work at Evercore ISI. But let's dovetail the stock market, the equity market, and ownership of American equities into your economics. With all of this said, are we at a point of 1975 or maybe the great bull market of 1982 where corporations, like they did then, will adapt and adjust and prosper?
Well, first, we have an open office architecture. And I learned this from Michael Bloomberg. This is when you were on Park Avenue. Mm-hmm. And so I'm cursed with the fact that Julian sits right next to me. So I have to put one up with the guy all the time. But he is terrific, and thanks to the world of all three of you. But on the current picture, my view is that inflation is the key. The Fed is going to keep tightening until either the economy slows. That inflation is the key. The Fed is going to keep tightening until either the economy slows or inflation slows significantly. And I think that inflation is slowing more than the Fed thinks. And a year ago, if I may say, I was pretty agitated that transitory was the wrong idea. Inflation was going up everywhere. Every place I looked, it was going up. And the Fed kept saying transitory, and they kept rates at zero. And now I see inflation coming down in most places. Unfortunately, it's not coming down in the most visible places that the Fed looks at, like the Consumer Price Index or the PCE. But as a student of this, I see it coming down in so many places underneath the surface in the real world, if you will. And so I think inflation is going to keep coming down. And I think it could undershoot the Fed's target of 2%.
Ed Hyman, thank you so much for this half hour. Generous of you to be with us. Edward Hyman is with Evercore ISI with a disinflationary call. That's the heart of it, Lisa. I mean, really, and he's done this before, and you know, with great respect, Ed's been lagged before, and maybe when some of his thoughts happen, maybe they happen a little later than he thought they would work out. But the division here, the distance that Ed Hyman and other disinflationary optimists are from the street, I don't believe I've ever seen.
It's, again, it goes to the confusion of the moment. What Ed Hyman was just talking about there was fascinating, the technological advancements that could potentially bring down certain basic utility costs, right? So this would be a disinflationary force. You pair that with a deglobalization of sorts that people are talking about, or a reglobalization, and what that does if China isn't the factory to the world that it once was, or doesn't provide the disinflationary force. How do you put this together into an equation? How do you go back to previous models and put in the right numbers and understand whether or not your model is even correct?
Can you use previous models given a medical event? And that's where, and I go back, the heart of it, folks, for me is I've laughed, what, for 35 years at my grandmother with a scotch in her hand telling us about the pandemic of 1919. We thought she was nuts.
But it's not just the pandemic. But it's not just the pandemic, right? I mean, we saw an acceleration of work from home, of, you know, remote work, of what we're seeing with respect to a more nationalistic view. It's all of these different cross currents put together. My father is a mathematician, and he once said to me, you know, it's great when you have a nice model, but the models are always wrong. And if you take a look, your parameters are always wrong when you take a look at your models and understanding the moment that you're in. And he's right. We're kind of in the dark a little bit.
I think we're hugely in the dark, and it's going to be great, you know, through the economic data. We got a lot of economic data coming up the end of the week, which is honest. Thursday tomorrow. Do we get claims again tomorrow?
We get claims tomorrow, but really the key one will be the PCE, core deflator, the key metric for inflation that the Fed looks at, which comes out on Friday at 8:30 a.m. Eastern. Yeah. Do you see that same upside surprise that you saw in PMIs and other inflationary types of metrics?
Mortgage rate 6.9%, as Ed Hyman mentioned there at the beginning of that conversation. I want to look at housing, and Michael McKee will have all of this for us. What an extraordinary morning. Futures up 8. The VIX shows the Yanks 23.10. Stay with us across radio and television. This is Bloomberg Surveillance. Good morning.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years. Or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Coming off the back of the worst day for equities of the year so far and trying to bounce by just 0.2% on the S&P 500. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, bonds and equities climb and fall together, waiting for some potentially stale Fed minutes, and China says its relationship with Russia is rock solid. We begin with a big issue. Will February confirm the January boom?
January was strong. January data were so tough.
Exceptionally strong data.
The payrolls number and the retail sales and the CPI.
We want to see confirmation.
Confirmation in the February data.
Confirmation of the trend.
Waiting to see if those numbers are actually confirmed.
We have to get more clarity.
A few more data points that hopefully align in one direction. We do think you'll see moderation.
Maybe January was a one-off.
The downside risk is higher than the upside risk.
A lot can happen in the data.
You just have to look at the data.
So let's look at the data. Joining us now is TPW's Jay Pawlowski, Darryl Cronk of Wells Fargo alongside him, 30 minutes out from the opening bell. Gents, great to have you with us. Let's set the stage. Two-year yield, close to the highest since 2007. Equities off the back of the worst day of the year so far in the S&P 500. Darryl, to you, do you see a good chance that the February data confirms the boom we saw last month?
No, I actually don't think that the February data confirms the boom last month. I think to steal a word that was somewhat polarizing 12, 18, 24 months ago, I think the January data is somewhat transitory. I think it fades into February. Certainly, there's reason to look at the strength when you look at the PMIs, you look at the payrolls, you look at strong retail sales. But I think when you get underneath the data, John, it's not as strong as what people believe, and I think February and March will start to confirm that.
The early February read on the February data is in the PMI for the last 24 hours. 8-month high, was sub 50, now north of 50, I think for the first time since last June. Jay, do you believe that the January boom is transitory?
Well, I think we're in the beginning, John, of a new global growth cycle. It's not just the U.S., it's happening in Europe. The PMI is above 50. Consumer confidence at a one-year high, PMIs in Japan above 50, China starting to reaccelerate. So I think the bond market is trying to make sense of all this and has gone a long way to making sense of it. You and I talked several weeks ago, and I told you we didn't believe in the bond market rally, and it's all given back and even more. But I think the real key here, John, is the dollar. And the dollar is not really confirming the bond market sell-off. So that, to me, really speaks volumes.
When you say it's not confirming the sell-off, what do you mean by that, Jay? We've come down from 110.33 on euro dollar down to about 106. What were you looking for?
Well, I'm looking at DXY, John, and it sold off pretty. I mean, first of all, it's had a big move last year, 15% rally. It's given some of that back. It's had a little bit of a bounce, but yesterday, for example, it barely moved right around 104, even though bonds sold off 10 basis points in a single day, which is a huge move and caused the equity sell-off that you noted at the open. So to me, really, I see several things happening, right? Bonds have flipped from the most anticipated recession to worrying about a 6% Fed funds rate. Stocks had a big move off to start the year. They've given some of that back. Importantly for us, it's confirmed the non-U.S. outperformance, which has been maintained over this little pullback. Commodities are not confirming any kind of big global growth boom, right? GSG is on the lowest it's been in the last 6 months. And the dollar, as I just noted, has not really confirmed a big move higher in terms of inflation or U.S. rates. So I think we're about at the end of this move. The confirmation of non-U.S. outperformance and the dollar not confirming a big move higher in rates says that we're pretty much done. And I think this is where you look for areas of opportunity, which is what we've been writing about for the last several weeks.
We can talk about those opportunities through the next 20 minutes or so. Talking about the commodity market, 6-day losing streak on crude. We're down again by 0.7% on WTI to 75.84. Just to bring up the bond market, Daryl, and what's been happening with bonds and equities. We came into 2023 and we all heard the same thing, that correlation, get my words out, between equities and bonds was going to break down. And Daryl, it's not happening. Yesterday was a great example of it. Treasuries down, yields up. They took equities with them. What's happening?
Yeah, I think Jay's right, but I think the difference on why the dollar's not confirming this is you're getting short-term rates higher, not just in the U.S., but across the globe. Japan's meaningfully higher on the short side of the curve. Europe's meaningfully higher on the short side of the curve. So I think the bond market, the U.S. 2-year is up 50 basis points already this month alone, in the month of February. So the bond market's coming back and basically telling you with that deep inversion, with LEIs, printing the 10th month in a row of declining, that tougher times are coming ahead and that the Fed has more work to do. And I think the equity market was late to acknowledge that. It's starting to acknowledge it now. And I think it's going to probably have some pressure as that data continues to weaken out into February and March here, John.
Jay, do you believe also that bond equity correlation can break too?
Yeah, I think only one of them can be right. We wrote a piece several weeks ago saying stocks and bonds, only one can be right. We think equities are right. I differ a little bit with Darrell on kind of what we expect to see going forward. Which we expect to see a gradual recovery in the U.S. economy. But importantly, John, as we've touched on, we don't expect the S&P to have a big year, right? So the fact that it got off to a great start at the beginning of the year and now pulls back, we think is healthy. The U.S. is expensive. Earnings growth is going to be, kind of punkish, plus 5%. So we're looking for a flattish type year in the S&P, plus or minus 5-10%. We don't think bonds are appealing, as we've talked about for some time. We don't like the long end of the curve. We do think it's kind of getting closer to where it should be with this latest sell-off, but we don't see it as attractive because we don't see a recession in the U.S. and therefore, we think the opportunities are better elsewhere where there's liquidity and growth starting to really percolate.
You don't like a 6-month T-bill at 5%, Jay?
It's becoming more interesting for sure, but I think, look, we think non-U.S. equity can be up 15 or 20% this year. So relative to that, no.
It's a big move. Daryl, I want your view on the bond market as well. I'm trying to work out whether you believe this is a once-in-a-generation opportunity to lock in some yield here, or a new generation of high yields. And I talked about this a little bit earlier this morning. That's a really important point. If you believe it's the former, a once-in-a-generation opportunity, lock it in, take on duration. If you believe it's a new generation of high yields, then maybe you can do a little bit more than that. What are your thoughts on it?
Yeah, I think the way to position in the bond market today is, we would say, to barbell, right? Take advantage of those short-term rates you just talked about, a 5 handle on the short side of the curve. But also, we do think you're getting closer to long-term rates that make sense. Adding duration here, again, probably a little bit on the other side of Jay, we do think the U.S. is probably heading for a recession later this year, so locking in some of these yields at these levels probably makes some sense. What's also interesting is you're starting to see high yield spreads quietly leak to the upside. We started the month about 385 over. This morning we're 440 over. That's a decent move in high yield spreads quietly, underneath the surface, where quality is starting to give up the ghost a little bit from that big January rally.
Darryl, what explains that? Spreads were so tight. We came into the year and all of a sudden we were looking at 385 on high yield spreads. What explains the backup, given that we've actually had confirmation of better news in the last month?
I think people are just moving up in quality, right? I think they see that the headlines suggesting, as I mentioned earlier, I mean, if you think about, you have deeply inverted curve, which we know we've had for quite some time, often a very clarion good indicator of tougher economic times ahead, if not recession. LEIs are down for 10 months in a row, and certainly in recessionary levels and territory when you look at leading economic indicators. The M2 money supply and M1 money supply have contracted at some of the fastest rates, in recent times. So all of that, along with the operating leverage that is happening on income statements, are pointing to some harder times ahead. And that's with what we've already done, John. If you extend this idea that, we're no longer talking about a Fed pause pivot, we're backing out rate cuts in the back half of the year, and we're saying now the Fed has more work to do, and likely global central banks have more work to do to arrest inflation and get it to a level you want. I think all of that means a tougher time for the economy. So you've got to play a little defense here. And to your good point, the long side of the curve probably has some attractive rates if we end up in a recession and rates come down from here.
Next up for the Fed conversation, Fed Minutes, a little bit later on this afternoon, 2 p.m. Eastern Time. Mike McKee joins us now from Washington. Mike, I have one question. A lot of people want to know. Mike, can they massage these minutes, given how dated, how stale they might otherwise be?
Well, they can to a point, John, but remember, this was 3 weeks ago. And as the two intelligent gentlemen you have on with you today are saying, a lot's happened since then. It's a completely different world out there. We've had the jobs report, we've had the CPI report and the retail sales report. All of this has changed the market's perception of what the Fed needs to do, and it's probably given the Fed a rethink about what they're going to do. I mean, the picture being worth 1,000 words thing here is you take a look at the yield curve, just what's happened since the Fed meeting. You can see how much we've seen interest rates come up. And so that does raise a question of, can the Fed send a message through the minutes that are 3 weeks old that would change any perceptions, or do they even want to? I mean, we can learn maybe who else besides Mester and Bullard suggested 50 basis points were needed the last time. That would be important if there are a lot of people who are leaning hawkish. What were they thinking about a pause in rates at the time? Because you can sort of extrapolate out what that might mean for the future. Was there a consensus for rates going above 5.1%? I think this is the thing that people are really going to focus on. Is there any clue as to where the terminal rate might go? And then finally, the lagged impact of rates on the economy and what's their recession outlook. Obviously, things have changed since then, but it's good to have a starting point to look at. The problem with the minutes, John, is that old saying of it's very difficult to make predictions, especially about the future.
Mike McKee, thank you, buddy. As always, Mike, thank you. I went through the data yesterday afternoon, yesterday evening, and just looked at what we've learned since that Fed meeting. Chairman Powell said at the start of the month that the disinflationary process had started. Then 2 days later, we got payrolls at 517,000, unemployment dropping to 3.4%, a big jump in the ISM services index for the month of January, CPI not dropping, CPI looking sticky, PPI with an upside surprise, retail sales coming in month on month with a 3 handle, jobless claims still in and around 200K, and we got the first look at the month of February yesterday with the PMI, and that is no longer sub 50, it's north of 50. So, Darryl, I'll ask you that question, shall I? How stale are these Fed minutes going to be later this afternoon?
I think fairly stale. I think Michael's right. I mean, all the data you just rolled off, came after the Fed meeting. I do think it's interesting, and I agree with Michael's point about, Cleveland's Mester and then Bullard both were suggesting the Fed needed to do 50. I don't think that, that carried the day, and we'll see that in the meeting minutes. But I also think there's a debate raging about what March means. We think it's 25. We think it's 25 again in May. And it's probably a coin flip for June for another 25. So the Fed's slowing down to better understand whether the resilient economy reflects time lags from the past tightening or a higher R-squared short-term terminal rate. But the Fed is going to be looking for more work needing to be done. I think that's the clear clarion message that's going to come from the Fed meeting minutes. They're not interested in a pivot and pause, and they're not slowing down or stopping, I should say. They're slowing down to that 25 basis point consistent hiking, but there is clearly more work to do.
Jay, in the news conference, Chairman Powell was asked about whether they discussed the pause, and he said, look to the Fed minutes. And at the time, I think a lot of people thought that maybe the Fed minutes might be a platform, the stage for the doves to dance. And now, Jay, a lot of people see these Fed minutes as totally stale. How will you interpret when they come out? How will you interpret them at 2 p.m. Eastern time?
Yeah, John, I'm not going to pay very much attention to them, to be honest. I really haven't for some time. I mean, you know, the Fed has not been particularly accurate with its outlook, so I'm not sure we want to give it much more attention than it's due, particularly something as stale as what we're going to hear this afternoon. You know, we focus forward at TPW Advisory, and to us, the market's already done a lot of this work, right? The market is now pricing in a higher terminal rate than it did at the end of last year. We're now at 5.3% in August. The market is priced in 25, 25, and 25 going all the way out to June. That's in the price. So as we look at it, we've gone a long way towards getting rid of the recession call, which we never bought. We're in a higher nominal growth world. So to your earlier question about, you know, is this a one-off yield play, or is this the beginning of a more sustained higher rate cycle? That's where we are, the latter for sure.
Connection lost.
That's because we're not going to have a recession in the U.S. There are no major imbalances. Housing is already bottomed, and the PMIs are turning up. So we really don't see that, and we don't see it anywhere in the world. We think we're at the beginning of a new global growth cycle that's emanating out of Asia. Liquidity provision out of Asia is significant. China provided more liquidity in the last 2 months, John, 3 times more liquidity in the last 2 months than in the prior 2 years. So we're in a global world, and Asia is providing liquidity and starting to accelerate. Europe is also, and we think the U.S. is going to, you know, have a decent year economically. The Fed, as I said, the S&P plus or minus 5 or 10%, not a lot of upside. The rest of the world is much cheaper, much less owned, and has the potential for a new global growth cycle in it, and that's where we want to be positioned.
We'll finish on that call in the next segment, Jay. You're going to stick with us. Jay Pawlowski, Darryl Crum, coming up. Tensions rising a year into war.
Our support for Ukraine will not waver. NATO will not be divided, and we will not tire. Ukraine will never be a victory for Russia. Never.
President Biden meeting with Eastern European leaders before heading back to Washington. More on that up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This
is Countdown to the Close. Welcome to Bloomberg Crypto.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
There should be no doubt. Our support for Ukraine will not waver. NATO will not be divided, and we will not tire. We're going to announce more sanctions this week together with our partners. We'll seek justice for the war crimes and crimes against humanity continuing to be committed by the Russians. Ukraine will never be a victory for Russia. Never.
Global divide and risk of deepening as allies reaffirm their commitment around the war. President Biden meeting with leaders from Eastern Europe. Putin meeting with China's Wang Yi in Moscow as President Xi prepares for a visit, according to the Wall Street Journal. China's top diplomat is saying this morning the current international situation is indeed critical and complex, but the relationship between China and Russia is solid as a mountain and can stand the test of international risks. Team coverage starts right now with Anne-Marie in Warsaw, Mark Champion in London. AMH, today's events, go through them for us, please.
Yeah, Jonathan, well, yesterday was all about this solidarity with Ukraine. Today is making sure the United States wants to make sure they have this solidarity and support for the eastern flank. The president right now is in a meeting with the Bucharest Nine. These are NATO countries. They were either part of the former Soviet Union or now the dissolved Warsaw Pact, also with Jens Stoltenberg at this meeting. When President Biden said today, meeting these Bucharest Nine leaders was what he repeated yesterday, which is that Putin wanted the Finlandization of NATO, but instead he got the NATOization of Finland and Sweden. His essence there and what he wants to insinuate is that NATO is not just more aligned, but it's expanding under his watch.
Mark, how on earth do you think the US is going to try and manage this relationship with China, given what we heard from China's top diplomat early this morning?
Yeah, it's getting increasingly difficult. You know, it's increasingly difficult for the U.S. to manage the relationship. It's also increasingly difficult for the Chinese to manage its partnership with Russia while trying to sort of not become explicitly part of the war. Supposedly, they're going to come up with a kind of peace plan. You know, whether China really wants to jump in and try to mediate a resolution to the conflict when neither side is ready to actually make any compromises is unclear. But there may well be a position that China is trying to take, which is simply to position China and Russia as kind of peacemakers and in a, you know, with the audience as the rest of the world, the global south, the non-West world, and position the U.S. and its allies as warmongers.
Hey, Mark, is a good point. That might be the effort. Mark Champion, AMH, to the both of you, thank you. Just fantastic. Phenomenal to read those headlines this morning. China, the relationship with them and Russia, solid as a rock. There'll be more on that through the day on TV and radio. Back with us, Jay Poloski, Daryl Krong. I want to come to you, Daryl. Your point on US equities, I know where Jay wants to be. It's Europe, it's the rest of the world, it's Asia, even with all this stuff going on. Daryl, the last time we spoke, it was IT, energy, the S&P, year-end 4,400, US over international. Daryl, is that still the case?
Yeah, I think you can balance it out a little bit at this point, John. International is obviously cheap. Jay makes that good point. If you get a more stable dollar environment, meaning you don't get the huge appreciation of last year, but you don't get significant depreciation from today's level, I think international can play much better than it has, candidly, for a decade. But I think within the U.S., you've got to sit, you know, it's well documented that at today's rate level on the reset through February, that equity risk premiums valuations are not terribly compelling here. I think if you get inside of that, though, different from the broad index level, and you look at various sectors, you've got energy still has is triple the equity risk premium that the S&P is. Financials are almost double the equity risk premium of where the S&P is. Healthcare still looks attractive. So there's some places that you can kind of hide out here as the economic data, in our opinion, continues to soften and play. It's interesting, the last time we were at this level of rates, which was early November on the yield curve, John, the S&P was in the lower 3,700s, and it was just coming off of a 35, 3,600 number. The VIX was at 30 to 33. Today it's 23. So the equity markets aren't buying kind of the latest sell-off and the move in rates. We'll see if they play catch-up or if they go a different direction.
It's a good point, Darryl. I was looking at the same thing last week as well. Yields have really backed up. The equities hardly moved compared to where we were. Jay, I've got about 45 seconds left. For people who don't know you, tell them why you like Europe so much.
Well, we like non-U.S., John, including Europe. We think Europe is in an early recovery. As I mentioned earlier, consumer confidence at a one-year high. Stocks are cheap. Money is starting to flow back. Asia is providing liquidity. China is accelerating. Japan is going to exit yield curve control. Very attractive reallocation opportunity, both domestic and foreign, into equities in Japan. And we think EM is about to begin a major up move supported by China. So we think right now you can look to add EM, China. We like housing. XHB has had 50% pullback from its move. If we're close to the end of the rate move, which I think we are, and housing is interesting in the U.S. So places to play all around the world, John.
Hey, Jay, wonderful as always. Jay Pawlowski, Darryl Cronk. The world's coming Jay's way. Slowly. It's just taken a few years. Coming up the morning calls and later. Not too bullish, not too bearish. RBC's Laurie Calvasina.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Minutes from the opening bell. Let's get you some morning calls. First up, Citi upgrading Alcoa to a buy, expecting shares to benefit as China continues reopening. Wolf Research upgrading Merck to outperform, pointing to a strengthening pipeline. And finally, Atlantic Equities downgrading AIG to neutral, highlighting the stock's rich valuation. That stock's negative 0.9%. Up next, RBC's Laurie Calvasina seeing upside risk to equities with investor sentiment rebounding. That conversation just around the corner, the opening bell. Up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Three-day losing streak on the S&P 500 from New York City this morning. Good morning, about 15-20 seconds away from the opening bell. Equities yesterday, dreadful. Worst day of the year so far on the S&P 500, down about 2%, trying to bounce. Futures up by about 0.1% on the S&P, on the Nasdaq up by 0.2%. There's the opening bell. Switch on the board and get to the bond market. Yields look a little something like this, down 3 basis points. The whole curve yesterday shifting 10 basis points higher. 2s out to 30s. We're down 3 this morning to 392.14 after coming very, very close to 4% on a 10-year. Euro dollar not giving me much, unchanged, 106.48, and crude giving us plenty, or taking back plenty, depending on how you look at it. Crude down, negative for a 6th straight session. We're down another 0.9%, $75 and about 70 cents. We're about 25 seconds into this one. We're positive 0.1% on the S&P. On the Nasdaq, we're up 0.33%. One stock to watch at the open, TJX, the retailer under pressure after delivering a disappointing forecast, following the likes of Walmart, Home Depot just 24 hours earlier. Abby has more. Hey, Abby.
Hey, John, and that's exactly right. It's the outlook once again weighing on this stock. We do have the stock down about 0.8%. And one reason that it's not down more, the quarter that they did deliver, it was decent, inline EPS estimates of 89 cents per share. They also beat the same-store sales estimate, up 4% relative to the estimate of up 1.1%. But so interesting, John, this stock was not priced for perfection. The industry group overall up 13% year-to-date. TJ Maxx, including today's decline, down 2.3%. So that could be a reason that it's not down more as well. Relative to, again, that quarter that just was, it was pretty strong, in fact, in terms of the earnings. There you can see in the blue bars the 89 cents per share. And then you can also see comp sales going in the right direction. So that's a positive. Out of the pandemic, the stock is up, but not as much as you might think. I would think that it's absolutely soaring given the stay-at-home shopping trend for home. And that was a piece of the most recent quarter. They're seeing less of that. But out of the pandemic, up just about 23%. The question on today, because again, the stock is down, is it going to follow the route of Home Depot, which fell the most in a year, down 7%, or will it turn around like Walmart, up just a little bit? Again, that adjusted earnings outlook missing. Investors are a little bit concerned about that.
Abby, thank you. Different story for Baidu. Let's pick up another name, renouncing a $5 billion buyback plan after reporting better than expected results. The company's CEO saying this: we have a clear path to re-accelerate our revenue growth, and we're now well positioned to make use of the opportunities that China's economic recovery offers us. That stock up by 5%. Katie Lights has more. Hey, Kaylee.
Hey, John. Yeah, nice move at the open here. Yes, revenue growth was flat, but still the figure came in above analyst expectations. You have cloud computing strength helping offset some of the weakness in advertising. And when it comes to actual profit, it doubled in the fourth quarter. One analyst over at Vital Knowledge calling that earnings growth, quote, explosive. That is largely due to cost-cutting measures, including a 23% drop in R&D. But we know there is R&D going on, including that AI chatbot they're getting ready to launch next month. Plus, the other big news here, as you mentioned, that $5 billion buyback program, which is equal to about 15% of the market cap. And of course, that market cap has gone up substantially over the last several months, John. If you take a look at the stock's performance since the low at the end of October, it is up more than 80%. Absolutely remarkable, though. It's worth noting since the recent high back on February 7th, the stock is down about 12% from then through yesterday's close. That is part of the broader cooling off we have seen in the rally for Chinese technology stocks in particular, but really Asian stocks more broadly. Now the MSCI Asia Pacific Index, as well as the Hang Seng, each only up about 3% year to date. Compare that with a 4.3% gain for the S&P 500, and of course Europe far outpacing all three of those markets, John.
Kelly Nice, thank you. Let's get you the update on the year to date and the gains on the session as well. 3 minutes into the session, we're up 0.2% on the S&P, and the Nasdaq up about 0.5%. Year to date, up a little more than 4% on the S&P, and the Nasdaq year to date up a little more than 10. The Nasdaq bouncing back big time year to date. US tech companies continuing to cut costs. Intel slashing its dividend payments to preserve cash for future investments. Google extending its global layoffs within Europe, cutting 240 jobs from its operations in Ireland. Joining us now is Isabel Lee. Isabel, what's happening?
Hi, John. Macro uncertainties seem to be the big theme this year, which is why companies are rushing to cut costs. We have Intel slashing its dividend payment to the lowest in 16 years. So from 12.5 cents, they're cutting it to from 36.5 cents, they're cutting it to 12.5 cents, payable June 1st. So that's the lowest since 2007, and that's a 66% cut. Had they stayed with their current level, it would have cost more than $6 billion in 2023. The CEO did say that it plans to increase its dividend payout sometime in the future. So the chip companies, as we know, are still reeling from a steep decline, taking a hit in their profits. Intel is also eliminating jobs, and it's not the only one. Google also announcing layoffs. In Ireland, the company said it will cut 240 jobs, representing 4% of their 5,500-strong workforce. And recall that earlier this year, Google said it will cut around 12,000 jobs globally. So Google joins a host of companies drastically scaling back their operations. This includes Meta, Twitter, and Amazon. But, despite this, if you look at the workforce of these companies, John, they're still not back to their pre-pandemic levels. So it remains to be seen if this cycle is indeed over.
Isabel, welcome to the show. This was great. Fantastic. Let's talk soon. Isabel Lee there on some of the big moves we're seeing in tech. RBC's Laura Calvasina saying this about markets. Looking ahead to next year, the stock market is focusing on 2024 when an earnings recovery is embedded in expectations. The key question is not whether we get a mild recession in 23. We think the market has already priced that, but whether we get one in 2024. Laurie Calvasina joins us now. Laurie, love catching up with you. You know that. Let's not bury the lead. Year-end price target 4,100. Do you still see upside risk to 45?
So look, we take a very quantitative approach to our targets, John, and as we go through the data, we have a few things that do point us to that 4,500 level. And so we've said that's not our base case. The preponderance of the models are getting us to 4,100, but 4,500 pops up a couple times. We see it on our valuation model, which bakes in some expansion if inflation moderates, as many have expected it to this year, and if we do get a couple of Fed cuts at the end of the year. Now, I know that's a more precarious assumption, but that's what the model gives us. If you look at the sentiment issue, which I think is maybe a little bit less controversial, if you look at the depths of individual investor sentiment at the end of last year, we were basically down around financial crisis lows for an extended period of time. And historically, when you've been below 10% in favor of the bears over the bulls, it's set you up for about a 15-16% return on the year. So that's something that gets us to a more constructive number at the end of the year. 4,100 is the base case. We still like that target very much, but we do feel like when we look at the sentiment work in particular, that if we're wrong, the bias is more to the upside in markets than to the downside.
Laurie, there are phrases that people hear people at banks say a lot, things like under-owned, over-owned. We came into the year and they said that tech stocks was under-owned, and that's what suggested, really validated the rally we've had year to date. Where are we on that, and how do you gauge what is under-owned and over-owned?
So we're still pouring through the 13F data. So that's something that could potentially give us some clues. But I'll tell you, John, the street feels like it's flying blind a little bit on the institutional side because the CFTC data hasn't been coming out. And something that I like to watch there is the level of NASDAQ futures positioning. Now, what among asset managers in particular, that's been a great barometer, I would say, for the last like 6 to 9 months. And it was something that really told us the market was about to kind of fall down and stumble a bit back in August because the NASDAQ futures were looking a bit overowned. Last we saw a couple weeks ago, it looked like we were sort of midway through a rotation back in. We were watching that data very closely, but of course the CFTC issue, we just don't have that data at this particular point in time. It does feel to me though, like based on conversations, there are so many people who hate this rally, who hate the rebound in tech stocks. It feels to me like they're still underowned at this point, but we'll see what the data shows when we finally get it back.
There's this line in your research about the messy post-crisis normalization. And Laurie, I just sat here thinking, what's normal anymore after a decade plus of zero rates? What is normal? What are we normalizing?
Well, what I think that we're trying to get back to is what it will essentially be a new normal, where rates will be a little bit higher. We won't have the same kind of support from the Fed. But we have to get to that point. And I think the point we're trying to make with that messy normalization period is everyone has wanted to say COVID is over. And you know what? I desperately want the whole sort of COVID era in markets to be over. But if you look back to the tech bubble bursting, if you look back to the financial crisis, it took a couple years for markets to get back on their feet and for us to get out of this period where things were chopping around a lot, when we were dealing with, sort of lingering recession fears, when we were dealing with, sort of getting out of volatility and frankly, for lack of a better word, all the drama that was going on. And I think we're still in that period where geopolitical angst is high. Some companies are still dealing with supply chains. We're still trying to get out of this, kind of Fed period. We need to get to that pause for markets to really settle down. But that's really what we're trying to say. Not that we're, going to go back to the way we were, but we're searching for that new normal. And it is just a messy, sort of return to that new plateau.
At the epicenter of that confusion, I think the retailers were there, tech firms were there too. Tech aggressively went out and tried to build capacity. Amazon, a decent example of that. You saw the retailers build up inventories, and it all came at the wrong time, and they had to drop prices. Yeah. Laurie, Home Depot yesterday down 7%. They're warning that ultimately labor prices are going to hit their margins. I just wonder on the labor front, Laurie, how pronounced do you think that's going to be as a theme? And can top-line growth grow quick enough in a high nominal GDP 2023 to offset some of that pressure in the middle?
I do think that margins are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor. A lot of these wage gains are going to be sticky. I think, frankly, a lot of employees were simply seeing a catch up in wages that might have been deserved in the past. And I don't want to jump down that rabbit hole, but I don't think we necessarily can assume that we're going back to sort of the wages of yesterday. So I think that that is something the street is struggling to contend with right now. And frankly, John, as I think about those retailers that reported yesterday, I do understand why we had a bad day in the market, because coming into yesterday, it seemed to me a lot of the companies on the consumer side were highlighting resiliency in trends that we hadn't really seen, any kind of stumble. So I think there was a little bit of a turn that happened yesterday, frankly, that spooked markets a bit.
Bank of America offers a bigger framework just to look at a little bit more, Laurie, and maybe I can get your opinion on that. Savita Subramaniam and the team over at BofA said this. They said the problem children from the GFC, financials, home builders and materials, and from climate risk, fossil fuels, have been starved of capital for 10 plus years. We like the capital deprived sectors. That from BofA. Laurie, does any of that speak to you?
It does, and I might focus on slightly different issues, but, I think Savita does fantastic work, and I think that's a really interesting way to look at the world. What we typically see around these big crises in markets, and again, I don't think we're completely out of the COVID era, but you tend to see big leadership shifts, right? So whatever was working heading into that crisis does not tend to be the leadership area in the market going forward. We talk a lot about industrials, which is a sector, frankly, we're neutral on. It's expensive. It has looked a bit crowded, but frankly, it's the only kind of interesting long-term secular growth theme out out there that we hear when you talk about reshoring, when you talk about the trade war, COVID, supply chains, everything sort of encouraging countries and companies to make things closer to home. We think that's a dynamic that's not going to go away anytime soon. So we think, industrials may, for example, stay crowded and stay expensive for quite some time. But I like the way she's thinking about the world in terms of thinking about those paradigm shifts. I think the street is struggling to figure out exactly what those are because, frankly, there aren't a lot of, terribly interesting growth narratives out there right now. I would probably point you to a slightly different part of the market, but I do like that idea and I do like that basic construct.
Laurie, can we finish on energy? Because they were the big winners of the last 2 years, up 47, 48% in 21 and 22, up close to 60%. Laurie, they're looking at those winnings over the last couple of years and thinking, can that really repeat? Is that where their leadership's going to be in this next bull market? Even when it comes, if it's here already, I don't know. Laurie, your thoughts on that sector?
So I take a slightly different, kind of view on energy. I talk to some people, especially a lot of my clients down in Texas, for example, and I do work at a bank, that's got a lot of investment in energy across the spectrum. And I hear a lot of people trying to make a case for energy as the next big growth sector. I don't think that I quite buy that. I do like energy. I am overweight. I think it's more, though, for me, of an area that's become investable again. I look at the sector. I see, sort of shrewder management teams that are focused more on costs, that are much more focused on things like dividends and buybacks. I feel like the yield appeal of that sector is giving investors an alternative to utilities. I feel like the Russia-Ukraine war has made us understand that you can't paint ESG with a broad brush. And there is, sort of an interest there from a national security perspective. So I feel like it's investable again. That's what I really like about the energy sector going forward. I will tell you, it's still cheap. I do think, though, the problem with this sector in the here and now is that it didn't see its earnings expectations properly adjusted for 2023 last year. So areas like energy and financials are having to go through that downgrade process right now. Once we get through that, I think it'll be, kind of a more interesting place to be. But I do, strive. I would push back on the idea that it's the next big thing in growth. I think it's just investable again and not orphaned anymore.
Well, that's a big change anyway, relative to where it was. Laurie, this was great. As always, it's good to hear from you. Laurie Calvasina there of RBC. Equities right now positive 0.25% on the S&P. Coming up, crude falling for a 6th straight day.
Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
That conversation up next.
Names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
McDonald's is more than 60 years old now. What is it that made McDonald's by far the biggest of the fast food companies?
I think it starts with the brand. I mean, we have a brand that is one of the most valuable brands in the world. It started with Ray Kroc recognized the importance of ubiquity. And so that was part of the genius or genesis of doing a franchise model, because with a franchise model, he could get capital deployed, get restaurants built more quickly than he could if he was trying to do this all on his own.
There's been a greater interest in the United States and maybe around the world in healthier eating. Yeah. Have you tried to reflect that in your menu?
I'd say, what we try to do on our menu is to have choice. So we have a variety of things on our menu, from more indulgent items to, healthier items. And, it gets back to, again, what sells gets on the menu and stays on the menu. What we have seen consistently is, as we've tried to broaden more of what people might say are better for you items, there's just not as strong a demand for them as there are for some of our iconic classics. And so, we're not in the business of telling people what they should or shouldn't eat. Our view is our obligation is to provide them with total transparency on nutritional information to make sure that we afford them choice, but ultimately what the consumer buys is up to them.
What about what happened in Europe? That's the big one for oil. Really big warm weather shock drove gas prices down sharply, particularly in Europe. We have TTF, dropping all the way down to 49 euros a megawatt hour right now. Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
Oil extended its longest run of losses this year. WTI falling for a 6th straight session as markets await rate hike hints from the Fed minutes. This is U.S. natural gas futures dipped below $2 for the first time since 2020. Will Kennedy of Bloomberg joins us now out of London. Will, great to catch up as always. What happened to triple-digit crude on that one-way train to 3 digits off the back of China reopening?
I think two things happened. One, the change in macro conditions, the idea that rates are going to have to rise higher than people previously thought, and what that does to the dollar is always a significant headwind for commodities, and I think it's pressuring the whole complex right now. And then second, as you had Jeff Curry talking about, natural gas prices have just collapsed around the world as we've come out of the winter, and at the margin that allows for some substitution and is weighing on the broader energy markets too.
Well, how much of this is just about the weather?
In the natural gas market, it is essentially about the weather. I mean, we're through winter and it hasn't been as warm as people had expected, cold as people had feared on either side of the Atlantic, and that means that in Europe especially, there were plenty of stockpiles and the demand for the gas just wasn't there, so the price of near-term gas futures has just collapsed. And in the US, you've seen a similar pattern, and we've had a big outage at this plant on the Gulf, which exports gas, which means that exports have been much lower than people expected. And it's just, we've seen prices in the US just collapse, down 70% since November, and as we see today, below $2 for the first time since the depths of the pandemic.
Remarkable, just an amazing turnaround. And Will, thanks for the coverage as we followed and tracked all of this. In the Bloomberg story today, available on the terminal and of course on Bloomberg.com, there's this great paragraph that just goes through the temperatures. Across the contiguous 48 states, January was the 6th warmest on record. If you go through these 6 New England states as well as New Jersey, they were warmer, the warmest ever recorded, according to the U.S. National Centers for Environmental Information. New York, Pennsylvania, Indiana had their 2nd warmest January in data going back to 1895. Just gives you an idea of how warm it's been to start the year. Looking at energy stocks struggling once again off the back of some of this, facing a 7th day of declines with the index among the worst performing sectors this year. Kelly has more. Hey, Kelly.
Hey, John, yeah, no surprise if you're seeing declines in oil. You also don't see energy stocks hanging in there very well. That once again is the case today. You're seeing some of the majors like Exxon and Chevron under a little bit of pressure here in the first 20 minutes or so of trading, down a few tenths of 1%. But of course, this year, they really have been sitting out the rally. Exxon roughly flat on the year, but both Chevron and ConocoPhillips down more than 10% on a year-to-date basis. The energy sector as a whole is down about 4% in 2023, down about 11% from its high last November. Obviously, a lot of that blame can be assigned to cooling oil prices, but we have to keep in mind the divergence we are seeing between those oil prices and the energy sector. While oil is down nearly 40% from its peak, that isn't the case for the S&P 500 Energy Index. Still, though, it is down on the year, actually the 3rd worst performing sector in the S&P 500 on a sector basis so far this year, after outperforming to almost a ridiculous margin in 2022, up 59% last year. And the three sectors that were closest to energy in terms of performance last year, down the least, are among the three sectors that are actually down the most in the S&P 500 this year as well, along with energy. So it's a story of last year's winners becoming this year's losers, John.
Big turnaround. Katie, thanks for that. About 22 minutes into the session, trying to turn around here as well, trying to bounce on the S&P, up 1/4%, on the NASDAQ, up 1/2% with some sector price action. Here's Abby. Hey, Abby.
Hey, John. And yeah, that's the first up day that we're seeing so far for the S&P 500 in 4 days. Anemic volume, 20% below the average. Not a lot of drama, as you would say, relative to the sectors. Not surprisingly, more or higher, but outside of consumer discretionary, which is not entirely intuitive given the fact that you do have TJ Maxx down, but most stocks within that sector are higher. It's up 1%. The rest of the sectors not really trading more than 0.5% one way or the other. Healthcare, utilities on bottom, so defense not bid. Over the last 2 weeks, we of course have had this pullback, and not surprisingly, we have some sectors that are down sharply, including retail, given the fact that what we did see with some of the retailers, including TJ Maxx and Home Depot. The transportation index down very sharply, down 5.4%. The semi-cap equipment stocks and the semis, the chips, they're giving back some of this year's big gain. And then the media, it's kind of interesting, John, because of course, last week, one of those boards that we were looking at on the year, up huge. Now it's some consolidation of those gains.
Abby, thank you. Your equity market, broadly unchanged, positive about 1/4%. Your trading diary, up next.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
About 25 minutes into this, equities are positive 0.2% on the S&P 500, on the NASDAQ up about 1/3%. If you check out the bond market just briefly, big turnaround from yesterday. New highs for the year, 3.470 at the close on a 2-year. Yields now lower on the session by 6 basis points. Your 2-year 4.66, your 10-year down 5 basis points to 3.8981. Let's get to the trading diary. Fed minutes coming up at 2 p.m. Eastern Time, followed by Fed speak from President Williams at 5:30, then Bostic daily on Thursday. Plus, we get US GDP, core PCE, and another round of jobless claims as well. New home sales, income and spending numbers, and new sentiment survey to round out the week on Friday. That rounds out this morning for me. Good morning to you. From New York City, this was the countdown to the open. This is Bloomberg TV.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Moment news breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion.